Twice a year, Federal Reserve Chair Janet Yellen appears before the House Financial Services Committee to talk about the economy and monetary policy. At today's hearing, she highlighted recent job growth and said she expected higher rates of inflation. Yellen also said the Fed was on track to reduce its bond holdings in the coming months. Members questioned the Fed chair about financial regulations and the possibility of her being reappointed when her current term ends in February. Texas Congressman Jeb Hensarling chairs the Financial Services Committee.
I hope so. My wife looked at me and she's so supportive and thoughtful. She was like, "What are the important votes? And like, if I need to be induced, we'll do it around that." And I was like, "This is important."
Friday.
No, I'm better than that during practice. I was like, "You are the most important thing. Whatever we need to do for you." Yeah. Let's talk about scheduling.
Could we hold that thing in until Friday night?
That's right. That's exactly right.
But you think how fast?
Easily. From the moment I leave the office to the moment I can be at the hospital, it's like 2 hours and 45 minutes, so it's not bad. Yeah, agreed. They said even if she's induced, like they said it can take 48 hours. So it's like call me at the last 30 minutes. Yeah, that's what people say. Yeah. I'm counting on. Do you have a good July 4th? Did you do any parades or anything fun?
No, we don't do parades or anything on July 4th.
It's like 97 degrees. Yeah, fair enough.
I'm actually very happy about it.
Yeah, fair enough.
Just go inside. Days off?
Good. Do anything particularly fun?
Well,
it is happy.
Yeah, July 5.
I'm telling everybody.
The committee will come to order without objection. The chair is authorized to declare a recess of the committee at any time. All members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. The hearing is for the purpose of receiving the semi-annual testimony of the chair of the Board of Governors of the Federal Reserve System on monetary policy and the state of the economy. I now recognize myself for 3 minutes to give an opening statement. Since we last convened to take Chair Yellen's testimony on monetary policy, there has been some very encouraging economic headlines. Confidence is up, headline unemployment remains low, as does inflation. But the headline unemployment rate still rests too much on an incredibly low labor participation rate and regrettably high disability payment participation rates. Both paychecks and savings for working Americans still have considerable room to grow after 8 years of distortionary economic policy under the previous administration. Fortunately, on the fiscal front, help is on the way. House Republicans have passed both the American Health Care Act to lift the burden of Obamacare from our economy and the Financial Choice Act to end bank bailouts and unleash trillions of dollars of capital sitting on the economic sidelines due to Dodd-Frank. These are landmark pieces of legislation. In the months to come, the House will vote on a fairer, flatter, more competitive tax code that will undoubtedly bring us a far healthier and dynamic economy, and the Trump administration is busy rolling back rules that harm our economy as well. Monetary policy must, of course, do its part as well. I am highly encouraged that Chair Yellen and her colleagues seem to be on track towards some type of monetary policy normalization. Keeping interest rates artificially low for too long was a key contributing factor to the last crisis. Let us hope it does not prove to be a key contributing factor to the next. What is most desirable for long-term economic growth is for the Fed to set out an easily discernible and transparent policy strategy to achieve its mandate and, but for highly exigent circumstances, to stick to it. Forays by the Fed into fiscal policy, specifically credit allocation, cannot, should not be permitted. Assuming press reports are accurate and the Fed will soon commence an orderly wind down of its balance sheet, this is more good news. Both the size and composition of the balance sheet remain alarming. Intervention into distinct credit markets like mortgage-backed securities is inherently fiscal policy, not monetary policy. Already there is talk of having the Fed bail out student loans and public pension funds. I again maintain if we are not careful, we may wake up one day to find our central bankers have instead become our central planners. What has allowed the Fed's foray into credit allocation is the policy of paying interest on excess reserves and today paying a premium over market. Interest on required reserves was meant to counteract an implicit tax. Interest on excess reserves should not become a permanent tool of monetary policy. Normalization would suggest, after setting the level of reserves, short-term interest rates be set by market forces. But today they are set from the top down by an administered rate paid on excess reserves, which again is a premium rate resting on uncertain legal authority. Forays into credit allocation and fiscal policy threaten the Fed's independence and economic future, so let's hope the normalization has truly begun. I now recognize the ranking member for 4 minutes.
Thank you, Mr. Chairman, and thank you, Chair Yellen. It is a pleasure to have you with us today. Since day one, the story of the Trump administration has been one of chaos and turmoil. This creates uncertainty that threatens the progress of our economy and the opportunities available to all American households. Trump made many big promises to hardworking Americans about ushering in a new level of economic prosperity in America. Yet, despite all of his bluster, let's look at what Trump has actually done when it comes to our economy. None of it is good. He reversed a planned cut to Federal Housing Administration mortgage insurance premiums that would have saved homeowners $500 a year. He issued executive actions to begin to dismantle Wall Street reform and embraced the Wrong Choice Act, the chairman's bill to gut Dodd-Frank Wall Street reform and consumer protection, and hobbles the feds. There are actions that endanger the economic progress we've made since the Great Recession. In passing the Wrong Choice Act, House Republicans once again are trying to weaken the independence of the Fed and chain the Fed's policy decisions to a mathematical formula that would diminish its ability to support the economy and fulfill its mandate to promote full employment. The Republicans' bill would also subject federal financial regulators, including the Fed, to the politicized annual appropriations process. All of this wasn't bad enough. President Trump will soon have the opportunity to reshape the makeup of the Board of Governors, thereby tilting policy in the direction of Wall Street. For example, earlier this week, the White House announced the president's intent to nominate Randall Quarles to serve as the Fed's vice chair for supervision, an important post responsible for overseeing the Fed's implementation of Wall Street reform. This is troubling, given Quarles' public opposition to key aspects of the Dodd-Frank law and support for measures that would curtail the Fed's independence. While our economy has made substantial progress since the height of the financial crisis, and we continue to see positive trends in the labor market as a result of the policies put in place by the Fed, congressional Democrats and President Obama, key aspects of our economy have yet to fully recover. Since your last testimony before this committee, wage growth continues to lag, and troubling economic disparities continue to exist among racial and ethnic lines. So I hope Fed policymakers will keep these trends in mind, and the fact that inflation expectations have fallen as they evaluate the stance of monetary policy. So, Chair Yellen, I commend you for your steady leadership and look forward to your testimony. And with that, Mr. Chairman, I will yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Kentucky, Mr. Barr, the chairman of the Monetary Policy and Trade Subcommittee, for 2 minutes.
Chair Yellen, welcome back to the committee. And despite nearly 9 years of the most accommodative and unconventional monetary policy in U.S. history, and despite some recent positive economic news, labor force participation remains at a disappointing 40-year low, wages are stagnant, and economic growth has yet to eclipse 3%. Making matters worse, just like the Farm Bill used to pay farmers not to plant, the Federal Reserve, by paying interest on excess reserves, is effectively paying banks not to lend. Former Fed Chairman Ben Bernanke said as much in 2013 when he stated, quote, "Banks are not going to lend out the reserves at a rate lower than they can earn at the Fed," unquote. The Fed has adopted this interest on excess reserves policy to fund its enormous $4.5 trillion balance sheet. By guaranteeing the largest banks in America this low-risk, above-market rate of return on deposits, the Fed is discouraging lending into the real economy, effectively taking money out of communities across America and leaving less capital for Main Street households and businesses to prosper. I was glad to read about the Fed's intentions to start shrinking its oversized portfolio. I share the view of St. Louis Fed President James Bullard and others that this decision is long overdue. What concerns me, however, is that once again the Fed seems to be improvising instead of following a well-grounded strategy. Earlier this year, some officials pointed to another Fed funds rate increase in September with a move to start reducing the balance sheet beginning in December. Now we are hearing that the FOMC might start the portfolio reduction plan in September and put off until December any further interest rate increase. Again, I welcome initiating the process to reduce the size of the balance sheet sooner rather than later. But I look forward to your testimony and hopefully an explanation whether the Fed is once again changing its strategy, and if so, why. Thank you for coming today, and I look forward to your testimony about these and other topics. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, the ranking member of the Monetary Policy and Trade Subcommittee, for 1 minute.
Well, thank you so much, Mr. Chairman, and thank you, Madam Chairwoman, for appearing here for the annual Humphrey Hawkins report. I want to start out by thanking you for your very thorough and thoughtful reply to our congressional letter regarding disparities in labor markets for African Americans and other minorities. Thank you. It did not have a lot of solutions, but it was very thoughtful, pointing out projects that seek to find the answers. This disparity is really clear among minorities, but I'm concerned that it is also increasing in all populations of working Americans. And it seems pretty clear from the research that the challenge moving forward will be able to use fiscal policy to address income and wealth inequality in a way that the blunt instrument of monetary policy can't, especially as the Fed moves forward to raise rates. I understand you have to do it, but there is an asymmetric recovery that is troubling. And given that the poor and working class have not felt the benefits of the booming stock market and that inflation is under control, I think that Congress can and should use the power of the purse to shore up those segments of the population that are still hurting from the recession. And I look forward to hearing your testimony, and I yield back.
Time of the gentlelady has expired. Today, we welcome the testimony of the Honorable Janet Yellen. Chair Yellen has testified before this committee on numerous occasions, so I feel she needs no further introduction. Without objection, the witness's written statement will be made part of the record. Chair Yellen, you are now recognized for 5 minutes to give an oral presentation of your testimony. Thank you for being here.
Thank you. Chairman Henserling, Ranking Member Waters, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report to the Congress. In my remarks today, I will briefly discuss the current economic situation and outlook before turning to monetary policy. Since my appearance before this committee in February, the labor market has continued to strengthen. Job gains have averaged 180,000 per month so far this year, down only slightly from the average in 2016, and still well above the pace we estimate would be sufficient on average to provide jobs for new entrants to the labor force. Indeed, the unemployment rate has fallen about a quarter percentage point since the start of the year, and at 4.4% in June is 5.5 percentage points below its peak in 2010 and modestly below the median of Federal Open Market Committee participants' assessments of its longer-run normal level. The labor force participation rate has changed little on net this year. Another indication of improving conditions in the jobs market given the demographically driven downward trend in this series. A broader measure of labor market slack that includes workers marginally attached to the labor force and those working part-time who would prefer full-time work has also fallen this year and is now nearly as low as it was just before the recession. It's also encouraging that jobless rates have continued to decline for most major demographic groups, including for African Americans and Hispanics. However, as before the recession, unemployment rates for these minority groups remain higher than for the nation overall. Meanwhile, the economy appears to have grown at a moderate pace on average so far this year. Although inflation-adjusted gross domestic product is currently estimated to have increased at an annual rate of only 1.5% in the first quarter, more recent indicators suggest that growth rebounded in the second quarter. In particular, growth in household spending, which was weak earlier in the year, has picked up in recent months and continues to be supported by job gains, rising household wealth, and favorable consumer sentiment. In addition, business fixed investment has turned up this year after having been soft last year, and a strengthening in economic growth abroad has provided important support for U.S. manufacturing production and exports. The housing market has continued to gradually recover, aided by the ongoing improvement in the labor market and mortgage rates that, although up somewhat from a year ago, remain at relatively low levels. With regard to inflation, overall consumer prices, as measured by the price index for personal consumption expenditures, increased 1.4% over the 12 months ending in May, up from 1% a year ago, but a little lower than earlier in the year. Core inflation, which excludes energy and food prices, has also edged down in recent months and was 1.4% in May, a couple of tenths below the year earlier reading. It appears that the recent lower readings on inflation are partly the result of a few unusual reductions in certain categories of prices. These reductions will hold 12-month inflation down until they drop out of the calculation. Nevertheless, with inflation continuing to run below the committee's 2% longer-run objective, the FOMC indicated in its June statement that it intends to carefully monitor actual and expected progress toward our symmetric inflation goal. Looking ahead, my colleagues on the FOMC and I expect that with further gradual adjustments in the stance of monetary policy, the economy will continue to expand at a moderate pace over the next couple of years, with the job market strengthening somewhat further and inflation rising to 2%. This judgment reflects our view that monetary policy remains accommodative. Ongoing job gains should continue to support the growth of incomes and therefore consumer spending. Global economic growth should support further gains in U.S. exports, and favorable financial conditions, coupled with the prospect of continued gains in domestic and foreign spending and the ongoing recovery in drilling activity, should continue to support business investment. These developments should increase resource utilization somewhat further, thereby fostering a stronger pace of wage and price increases. Of course, considerable uncertainty always attends the economic outlook. There is, for example, uncertainty about when and how much inflation will respond to tightening resource utilization. Possible changes in fiscal and other government policies here in the United States represent another source of uncertainty. In addition, although the prospects for the global economy appear to have improved somewhat this year, a number of our trading partners continue to confront economic challenges. At present, I see roughly equal odds that the U.S. economy's performance will be somewhat stronger or somewhat less strong than we currently project. I will now turn to monetary policy. The FOMC seeks to foster maximum employment and price stability as required by law. Over the first half of 2017, the committee continued to gradually reduce the amount of monetary policy accommodation. Specifically, the FOMC raised the target range for the federal funds rate by 1/4 percentage point at both its March and June meetings, bringing the target to a range of 1 to 1.25%. In doing so, the committee recognized the considerable progress the economy had made and is expected to continue to make toward our mandated objectives. The committee continues to expect that the evolution of the economy will warrant gradual increases in the federal funds rate over time to achieve and maintain maximum employment and stable prices. That expectation is based on our view that the federal funds rate remains somewhat below its neutral level. That is, the level of the federal funds rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel. Because the neutral rate is currently quite low by historical standards, the federal funds rate would not have to rise all that much further to get to a neutral policy stance. But because we also anticipate that the factors that are currently holding down the neutral rate will diminish somewhat over time, additional gradual rate hikes are likely to be appropriate over the next few years to sustain the economic expansion and return inflation to our 2% goal. Even so, the committee continues to anticipate that the longer-run neutral level of the federal funds rate is likely to remain below levels that prevailed in previous decades. As I noted earlier, the economic outlook is always subject to considerable uncertainty, and monetary policy is not on a preset course. FOMC participants will adjust their assessments of the appropriate path for the federal funds rate in response to changes to their economic outlooks and to their judgments of the associated risks as informed by incoming data. In this regard, as we noted in the FOMC statement last month, inflation continues to run below our 2% objective and has declined recently. The committee will be monitoring inflation developments closely in the months ahead. In evaluating the stance of monetary policy, the FOMC routinely consults monetary policy rules that connect prescriptions for the policy rate with variables associated with our mandated objectives. However, such prescriptions cannot be applied in a mechanical way. Their use requires careful judgments about the choice and measurement of the inputs into these rules, as well as the implications of the many considerations these rules do not take into account. I would like to note the discussion of simple monetary policy rules and their role in the Federal Reserve's policy process that appears in our current monetary policy report. Let me now turn to our balance sheet. Last month, the FOMC augmented its policy normalization principles and plans by providing additional details on the process that we will follow in normalizing the size of our balance sheet. The committee intends to gradually reduce the Federal Reserve's security holdings by decreasing its reinvestment of the principal payments it receives from the securities held in the system open market account. Specifically, such payments will be reinvested only to the extent that they exceed gradually rising caps. Initially, these caps will be set at relatively low levels to limit the volume of securities that private investors will have to absorb. The committee currently expects that, provided the economy evolves broadly as anticipated, it will likely begin to implement the program this year. Once we start to reduce our reinvestments, our securities holdings will gradually decline, as will the supply of reserve balances in the banking system. The longer-run normal level of reserve balances will depend on a number of as-yet unknown factors, including the banking system's future demand for reserves and the committee's future decisions about how to implement monetary policy most efficiently and effectively. The committee currently anticipates reducing the quantity of reserve balances to a level that is appreciably below recent levels, but larger than before the financial crisis. Finally, the committee affirmed in June that changing the target range for the federal funds rate is our primary means of adjusting the stance of monetary policy. In other words, we do not intend to use the balance sheet as an active tool for monetary policy in normal times. However, the committee would be prepared to resume reinvestments if a material deterioration in the economic outlook were to warrant a sizable reduction in the federal funds rate. More generally, the committee would be prepared to use its full range of tools, including altering the size and composition of its balance sheet if future economic conditions were to warrant a more accommodative monetary policy than can be achieved solely by reducing the federal funds rate. Thank you. I'd be pleased to take your questions.
The chair now recognizes himself for 5 minutes for questions. Chair Yellen, the first question I have is with respect to the 2% inflation target that was adopted several years ago. I must admit, as an aside, a back-of-the-envelope calculation tells me that nominal prices will double every generation. I'm still trying to figure out how that is commensurate with price stability, but that is not my question. In a recent press conference, some interpreted comments that you made to indicate that you were open to an increase in the inflation target. Are you pursuing an increase in the inflation target? Are other members of the FOMC? Is this a matter of discussion within the FOMC to increase the 2% inflation target?
It is not. We reaffirmed our 2% inflation target in January. We are very focused on trying to achieve our 2% inflation target, and it is not a subject of discussion.
Thank you. I will take no for an answer. As you heard in my opening statement, I remain concerned, as do other members, about a blurring between the lines of monetary policy and fiscal policy, specifically credit allocation. We feel that ultimately this could impede upon the Fed's independence. Professor Marvin Goodfriend, who I think you may be familiar with, of Carnegie Mellon, gave what I thought was an instructive distinction between monetary and fiscal policy. And he said, quote, monetary policy does not favor one sector of the economy over another. And monetary policy does not involve taking credit risk onto the Fed's balance sheet. By contrast, he went on to say, credit policy works by interposing the government's creditworthiness, the power to borrow credibly against future taxes, between private borrowers and lenders to facilitate credit flows to distressed borrowers. Fed credit policy involves lending to private institutions or acquiring non-treasury securities with freshly created bank reserves or proceeds from the sale of treasuries from the Fed portfolio. I guess my question is, Chair Yellen, do you agree with this distinction? And if you don't agree with this distinction, do you feel that credit policy is commensurate with your congressional mandate?
Well, the FOMC in its principles for normalization of monetary policy has clearly indicated that it intends to return over time to a primarily Treasury-only portfolio, and that's in order not to influence the allocation of credit in the economy. That said, our purchases of mortgage-backed securities took place after a financial crisis when the market for mortgage-backed securities was not working at all well, and I believe it was appropriate, but we have endorsed the principle
I understand that,
returning to a Treasury portfolio.
Yellen, so do you or do you not associate yourself with Professor Goodfriend's comments? Is that a useful distinction to you as he articulated it?
I think it is a useful,
is
a useful distinction.
It is my understanding that the Fed can legally purchase student debt guaranteed by the federal government and municipal debt that matures in less than 6 months. Is that your understanding as well?
I'm not sure about student debt. We're able to purchase Treasury and agency securities.
Has the FMOC ever discussed the possibility of either purchasing student debt or municipal debt?
Not to the best of my knowledge.
Okay, finally to end this part of the questioning, am I led to believe then that your balance sheet reduction will allow you to return the Fed funds rate as the primary policy instrument instead of reserves, instead of interest on reserves? Is that my understanding from your testimony?
Well, we are reliant on interest on excess reserves as our key tool for setting the federal funds rate. So that is a key instrument of monetary policy. But what I said is that we intend to rely on adjustments through interest on reserves to our Fed funds rate target as a means of regulating credit.
My time is rapidly winding down, perhaps not in a question, but a request. I was very heartened to see in your report a comparison of Fed policy with a number of policy rules. I think this is very helpful, Chair Yellen. I would say, though, that in some respects, your report says how the FOMC differed from these policy rules, but it did not say why. In order to give the broadest amount of information to the markets so that people can plan their lives, I would simply encourage you to perhaps even go further and discuss how, not how, but why the actual FOMC policy differed from these policy rules. I think that would be very encouraging if you would have a brief comment on that.
So let me just say I'm very pleased that the committee found the material on rules useful, and we look forward to working with you to provide further information that would be useful to the committee.
Thank you. I now recognize the ranking member for 5 minutes.
Thank you, Mr. Chairman. As part of the Federal Open Market Committee's statement on longer run goals and monetary policy strategy, the committee states that it would be concerned if inflation were running persistently above or below its 2% objective. Given that core inflation has been below the Fed's 2% target for more than 5 years and is currently at 1.4%, what is the Fed's rationale for further raising rates at this time? If the 2% market truly is symmetric, shouldn't the Federal Open Market Committee be willing to allow inflation to begin rising closer to its 2% target before it's able to justify additional rate increases?
So let me say that we're very committed to achieving our 2% inflation objective and are well aware that for a number of years we've been running under that, and recognize that there are dangers that would be associated with persistent undershoots of our inflation objective, and it is a symmetric inflation objective. 2% is not a ceiling, it's a symmetric objective. Now, I would say with respect to the inflation outlook, although inflation has been running below 2%, earlier this year on a 12-month basis, core inflation had reached 1.8%, and headline inflation came close to 2%. We have seen increasing strength in the labor market. That continues, and although there are lags in this process, I believe that that's something that over time will put upward pressure on both wages and prices. Now, for several months running, we have seen unusually low inflation readings. As I mentioned, there appear to be some special factors that partly account for that. For example, quality-adjusted prices of cell phone plans plunged several months ago, and prescription drug prices also plunged. So some temporary factors appear to be at work. Nevertheless, so our 12-month inflation rates will remain low until those factors drop out. But I would say it's premature to reach the judgment that we're not on the path to 2% inflation over the next couple of years. As we indicate in our statement, it's something that we're watching very closely, considering risks around the inflation outlook. To my mind, a prudent course is to make some adjustments as long as our forecast is that we're heading back to 2%. But monetary policy is not on a preset course. We're watching this very closely and stand ready to adjust our policy if it appears that the inflation undershoot will be persistent.
Thank you very much. I'd like to move on to ask you a question about Deutsche Bank. First, I'd like to commend you and your colleagues at the Federal Reserve for recently fining Deutsche Bank, a top creditor of the president and his immediate family, for its failure to comply with anti-money laundering requirements. I'd like to learn a bit more about what you may have discovered in the course of your investigation of Deutsche Bank. Were you able to verify that Deutsche Bank had completed its own internal review of a Russian mirror trading scheme that took place from 2011 to 2015, and separately, as part of the Fed's supervision of Deutsche Bank's anti-money laundering compliance? Can you comment on the due diligence that the bank conducted on the accounts of President Trump and his immediate family members, given the high-profile nature of their accounts?
So we issued an enforcement action against Deutsche Bank for violations of Bank Secrecy Act, anti-money laundering procedures in the United States, and that was based on our own investigations. The mirror trades that you referred to occurred outside the United States. Recently, the UK FCA took an action against Deutsche Bank for those trades. Those are not ones that we're involved in looking at, and we haven't, of course, in the course of our investigations, looked into individual transactions with the president.
That was one of two reviews that was done in Deutsche Bank, the mirror trading and the high-profile politicians or elected officials review. Are you familiar with that?
I'm not familiar with the details. Our focus has been on the safety and soundness of the operations of Deutsche in the U.S.
Thank you. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from Kentucky, Mr. Barr, chairman of the Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman, and again, Chair Yellen, welcome back. And we welcome the decision, the announced intentions of the Fed to begin the process of reducing the size of its oversized portfolio. But in terms of the plan, and in terms of portfolio composition and balance sheet normalization, why does your plan contemplate rolling off Treasury securities at a faster pace than mortgage bonds?
So the differences are relatively slight. My expectation is, although one can't be certain of what the prepayments of principal will be on mortgage-backed securities, that ultimately our caps on reinvestment of mortgage-backed securities will not be binding, that they will only come into play in exceptional circumstances. So once we've phased in those caps, I don't expect them to be binding. The Treasury market is very deep and liquid. It's a huge market. Our intention in gradually phasing up these caps is to avoid disruption, and we're comfortable.
Thank you for that. And this kind of gets to the question of credit allocation. Let me move on quickly to the issue of and the Fed's use of interest on excess reserves as a monetary policy tool. The Fed is now paying banks 1.25% on their reserve balances. And if the Fed follows through with its normalization plans, the Fed will be paying banks a higher interest rate on the reserve sometime later this year. These interest payments, as I said in my opening statement, provide banks with a government subsidy to not lend out their reserves. Does the Fed have any evidence that banks are passing on these higher interest on excess reserves rates to their customers in the form of higher interest rates on customer deposits?
So my impression is that on larger deposits on CDs, that we're beginning to see some upward movement in the rates that are available to customers. but not on retail deposit accounts. My expectation is, although there will be a lag, that as the general level of short-term interest rates rise, that competition among banking organizations will begin to put some upward pressure on those rates, and
yet we looked at some of the what some of the big banks pay on customer deposits, 1 basis point for many of them. Multiple institutions paying only 1 basis points on customer deposits, and the Fed is paying 125 basis points. And so it doesn't appear as though any of this pass-through is happening to customer accounts, and that might compel the Fed to reconsider the merits of its IOER policy. Wouldn't it be better for, for growth if banks were encouraged to deploy more capital in the real economy instead of just parking it at the Fed in exchange for IOER?
So I don't see banks as parking it at the Fed and not lending. My discussions with bankers and the information that we regularly collect suggests that banks are looking to make loans. There was a period of very slow loan growth at the beginning of the year, but our surveys suggest was more a matter of demand than supply. So remember, our interest on reserves is at a very low level.
If I could just interject.
Rates on loans
yes, ma'am.
Uniformly higher.
I would just interject an editorial comment, and that is that the dilemma that the Fed now appears to face is that lowering interest on excess reserves, of course, would decrease the Fed funds rate, but normalization would also entail shrinking, would also entail moving back to the conventional open market operations. Let me finally, in my limited time left, talk to you a little bit about the limits of monetary policy. Of course, we know we've been struggling overall with slow growth and low labor participation, even though unemployment has come down, and you talk a lot about substandard productivity. What many employers say to me is that they simply can't compete with the government for labor and that the government is paying people to not work. And as you know, we're in the middle of this big debate in Washington about Obamacare and whether or not we should reform Medicaid. Here's what Alan Greenspan, who calls you a first-rate economist, said, quote, "You can't get growth going so long as entitlement expansion is anywhere near where it's been recently. It's eating up the sources of investment and the sources of growth. And you can't have it both ways. You cannot fund all of the entitlements everybody wants and expect that you're going to get a GDP out of that of 3% or more at an annual rate. The arithmetic just doesn't work." Wouldn't you agree that the structure of our welfare programs, including Obamacare, contain disincentives for work?
A brief answer, please.
So, to my mind, the major factor here is an aging population that is putting downward pressure on labor force participation. There are other factors that affect labor force participation as well, but the slow growth that we have and anticipate reflects in part an aging population and slow productivity growth.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, ranking member of the Monetary Policy and Trade Subcommittee.
Thank you so much, Mr. Chairman. Let me sort of pursue the question, Madam Chair, that Mr. Barr was raising with you with regard to paying people not to work. And he gave us an example, Medicaid. Just want to mention that kind of 2/3 of the people who use Medicaid are like in nursing homes and they're unable to work. Just want to point that out. I also want to pursue some questions from you that the chairman seemed to be very interested in some rules-based policy that the FOMC had put out there. And I want to note that a couple of weeks ago, you were very critical of the Taylor rule, one of the rules that seems to be favored by the leadership on this committee. I was wondering if you could spend just a little time talking to us about your reservations about the Taylor rule and the appropriate application of it.
Well, I don't believe that the FOMC should mechanically follow any single simple rule. But as we point out in the monetary policy report, policy rules do embody some principles of sound monetary policy. that should inform our policy decisions. And we have, for several decades now, looked at the recommendations of the Taylor Rule and a number of other different rules in deciding on the appropriate stance of policy. As we try to point out in the report, there are many different rules. There's no clear way to decide which one is better than others. They lead to a range of recommendations, so there's no single recommendation that comes out of a rules-based approach, and they require judgment in order to implement about measuring things like the GDP or output gap, and particularly the neutral real level of interest rates, something that we have been struggling with, as has the professional economics community now for many years.
Okay, well, thank you, Chair. So the Choice Act is a bill that we've pushed out of this committee, and it proposes sort of a rule-based monetary policy, and want to know what your thoughts specifically are about that piece of legislation.
So I've said on many occasions that I'm opposed to the requirements in the Choice Act.
What about subjecting the Fed to appropriations, the appropriations process?
I would be very concerned about subjecting the Fed to appropriations. We, of course, want to start with saying that we're obviously operating in all that we do under congressional mandates and laws. We seek to be transparent, to be accountable to Congress, and to communicate as clearly as we can the basis for our actions in monetary policy and also in supervision. But I do think our independence in setting our own appropriations.
Thank you for that, Madam Chair. I just want to get back to the limitations that the FOMC has with regard to closing the disparity and the gap of recovery for African Americans, lower income whites. There's just only so much you can do. So I was wondering if you would agree that some of the austerity measures that Congress constantly places, like, saying that we're paying people not to work, when actually people who receive food stamps are, those are old people, disabled people, and children, Medicaid. Would you say that Congress needs to step up on the appropriation side, doing things for lower income people to subsidize wages, that is a better tool than what the Fed has to offer in closing those gaps?
As you indicated in your opening statement, monetary policy is a blunt tool, and it's not something that we can use to achieve distributional objectives, although, as we point out in the report, a strong labor market does benefit all groups, and particularly minority groups, although the experience is worse for them. So yes, I think it's absolutely appropriate for Congress to consider appropriate fiscal policy and how it might be used to advance those objectives.
Thank you so much, and my time has expired.
Time of the gentlelady has expired. The chair now recognizes the gentleman from New Mexico, Mr. Pierce, chairman of our Terrorism and Illicit Finance Committee.
Thank you, Mr. Chairman, and thanks to you, Chair, for being here. We always appreciate your visits. Now, I note in your comments today, you're talking about the labor force participation rate, and in the past, I think you and I have had an opportunity to discuss that, and it was not something that seemed to be a concentration on the part of the feds before now, and it is now. What changed that it's become a bigger concentration for you all?
So it's important for us to try to determine how much slack there is in labor markets, how much potential
Sure, I understand that, but that was important before, but there didn't seem to be any comments from you. In fact, in 2016, it was just a number that didn't come readily to your mind when you're in front of the committee here. I just wondered what has changed since January that you would now be concentrating on that, but
So, I mean, I think I was discussing this last year because it is a source of uncertainty after a very long and deep recession. We want to understand what potential there is for people to come back. And as I mentioned in my testimony, labor force participation rate has been...
No, I appreciate that. If I could grab up my time now. I'm going through the monetary policy report here, and I'm going through your comments. And I almost don't see anything about that number on the screen behind you. It's just constantly rolling there, and it's a debt. And maybe it doesn't mean anything, and sort of maybe it does. Do you all ever talk about that in your committee? Do you ever contemplate that in your position?
Well, I've discussed this previously with this committee.
I understand, but we didn't get
others.
it into the report today as one of the driving factors and something we ought to be thinking about. So how did it affect you all when Illinois was downgraded, their bond rating was downgraded the first of the year, and they are paying what one analyst said is the highest differential in our history? Now, that's the reason they're having to pay more and the bonds being downgraded is because they can't afford to pay the bills, basically. And if you hold their bonds, you may not get paid. If you went back to Detroit when it filed bankruptcy, bondholders only got 74% on the dollar. And so, I mean, it all feeds back toward this number here and the fact that it doesn't even make the print, not even the fine print that I could find. Maybe I missed it, but I did see the one sentence about Illinois being downgraded, and there was a brief discussion of Puerto Rico. But the idea that we as a country are not discussing our ability to pay our bills is something that I think there's a downside effect to the problem. But the fact that your report doesn't bring it up is a little concerning to me. And the way that really played out was a couple of weeks ago when Chicago schools tried to issue a bond rating, and they didn't get any bidders at all, none. So they ended up driving the rate up to 7.5, 7.75 or something. But it seems like that the people in charge of the financial stability of the country, the value of our dollar, the value of our promises to pay, it just seems like it would have a little bit more important in the document here. I would expect, frankly, maybe a whole chapter, because there are estimates that we can't pay our bills in this country, and so we continue to operate as if it's not going to matter if our ratings are downgraded, if our interest rate goes up. We're already running deficits, which means we have to print the money every year in which to operate, and it seems like that the people in charge of the system would be talking about it and postulating and telling us, hey, this is kind of serious. Why don't we all work together and start figuring out what we can do to live within our means, to just make sure that we're not paying triple and quadruple what other people are paying for debt? I'd love to hear your comments.
Well, let me state in the strongest possible terms, I agree that what you're showing here represents a trend that, given current spending and taxation decisions, is going to lead to an unsustainable debt situation with rising interest rates and declining investment in the United States that will further harm productivity, growth, and living standards. I believe a key thing that Congress should be taking into account in designing fiscal policy is the need to achieve sustainability of this debt path over time. This is something I'm not just saying today, but have been emphasizing for some time in my testimony.
Thank you very much. I yield back, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Chair Yellen, as you mentioned earlier, inflation has not been moving up as quickly as the Fed had been expecting. And given that the labor market has continued to tighten and inflation still hasn't increased to the Fed's target of 2%, do you think the Fed should wait to see some improvement in the inflation outlook before it starts the process of balance sheet normalization by phasing out the Fed's reinvestment policy? Or in other words, are your plans for the timing of balance sheet normalization unchanged?
So we've been trying to very carefully lay out our plans to normalize the size of our balance sheet in a gradual and predictable way. And my colleagues made the judgment in June when we laid out the final details that if the economy continues to evolve in line with our expectations, that it's something that we should begin to do this year, and to my mind, I would say relatively soon. The exact timing of this, I don't think matters a great deal. It is something we've long been preparing to undertake. As I mentioned earlier, we are watching inflation very carefully. I do believe that part of the weaknesses in inflation represents transitory factors, but we'll recognize inflation has been running under our 2% objective, that there could be more going on there. It's something that we will watch very carefully and will be a factor in our future decisions about rate increases.
Thank you. As you know, your term as Fed Chair ends in 2018, and there is a long history of presidents renominating Fed chairs that their predecessors had originally named. Ronald Reagan renominated Paul Volcker, Bill Clinton renominated Alan Greenspan, and President Obama renominated Ben Bernanke. So my question is, are you open to serving another 4 years as Fed Chair if President Trump decides that he wants to renominate you?
So what I've previously said is that I absolutely intend to serve out my term. I'm very focused on trying to achieve our congressionally mandated objectives, and I really haven't had to give further thought at this point to this question.
Okay. When the Fed does start the process of balance sheet normalization, are you less likely to raise interest rates at the same time, or do you view these two actions as being on separate tracks?
So the path for the federal funds rate is a decision for the committee that they've made no decision about whether or not both things could occur at the same time. I would note that in June, at our most recent meeting, we produced the summary of economic projections, which appear in the monetary policy report. Most of my colleagues, or at least the median, anticipated that one further increase in the federal funds rate would likely be appropriate this year. But as I say, we constantly watch the economy, the evolution of inflation in the labor market, and we'll make decisions on the basis of our evaluation of that information.
The Fed has suggested that the stock market is currently overvalued. Are there other markets that you consider or see as overvalued as well? And do you think a correction in any of these markets would cause problems for financial stability?
So in looking at asset prices and valuations, we try not to opine on whether they're correct or they're not correct, but on, as you asked, what the potential spillovers or impacts on financial stability could be of asset price revaluations. My assessment of that is that as asset prices have moved up, we have not seen a substantial increase in borrowing based on those asset price movements. We have a financial system, a banking system that's well capitalized and strong, and I believe it's resilient.
Okay, thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and thank you, Madam Chair, for being here today. As chairman of the Financial Institutions Subcommittee, one of my jobs and greatest concerns is the regulatory oversight by the various financial services agencies. Chair Yellen, when it comes to the Fed's supervisory role, I want to renew my call and the calls of so many of my colleagues that the Fed take a more measured approach and withhold any new regulation until the nominee for Vice Chair for Supervision has been confirmed by the Senate. I do appreciate some of your comments and the comments of your colleagues, particularly Governor Powell, on issues such as the treatment of margin on the supplemental leverage ratio and on CCAR testing. Issues like these have a very real impact on our economy, and I think it's wise that the Fed ease the associated burdens. You recall I sent you a letter on CCAR. Your response to me indicated that while you understood my concerns, the Fed wasn't necessarily looking to curtail some of its stress test-related activity. So now that a Vice Chair of Supervision has been named, I'll again ask that the Fed hold off on imposing any new supervisory burdens before that individual is in place, and I would just ask for a response to these statements and concerns.
So we have a relatively light regulatory agenda at this point. I'm pleased to see a nomination. Clearly, we will look very carefully at the whole set of issues around regulatory burden and look forward to having the input of that individual if he's confirmed.
Okay, thank you. To that end, I also want to mention that I'm very supportive of many of the provisions included in the recent Treasury report. I hope that the Federal Reserve is taking some recommendations seriously. Have you read the report yet? Are you aware of it?
Yes, I have read the report, and there are many very useful and productive suggestions that mirror things that we've been thinking and doing ourselves with respect to tailoring of our regulations, reducing burdens on community banks. I think the recommendations pertaining to Volcker Rule and looking for ways to reduce burdens are all very useful. There are a few points where we have a different view, but a lot in it that is very useful.
I look forward to working with you on that because while our branch of the government is a check on the executive branch and agencies, we want to work with you to try and improve the ability of our banks to be able to do the job of helping their communities grow. And I'm glad you mentioned community banks because I've got a quick story here for you. I'd like your response to it. I've shared this story with the committee in the past with regard to Mid-America Bank and Trust, a small bank in my district that's been caught in Federal Reserve purgatory for the last 5 years. Your agency has blocked the merger and acquisition of this institution because of concern over certain products, the same products that have actually been encouraged by the FDIC and the state of Missouri's Division of Finance. Your staff has forced this bank through the years to produce document after document, which they have done. And the bank has made now several offers to remediate, but the Fed has rejected them. Mid-America has spent more than $2 million in legal fees. Now, this is a small bank that really can't afford to do this. And this process has got to stop. The Federal Reserve, after 5 years, owes this institution a determination of whether they can get this done. So my first question is, are you aware of this case?
I am aware of this case.
Okay. What can be our expectation of the resolution of this?
Well, I'm not prepared today to comment in detail on what is a confidential supervisory matter, but there have been a set of complicated issues pertaining to consumer.
Well, Madam Chair, with all due respect, I understand where you're coming from. The bank on my side is very open about what their problems are, their concerns are. We have an elderly individual who has got medical problems who wants to divest themselves of this bank. They have a very viable, well-structured, well-financed, well-capitalized bank that wants to take them over. And basically what's happening here is a very punitive way of going about punishing this bank for a product that was something that the Fed didn't like, quite frankly. And so that 5 years this has gone on, and that's enough. And so the opaque rules and unwillingness of the Fed to work cooperatively with the banks and their attorneys and the regulators is not something we can continue to go and support. And this is why I asked the question, and we started back with the Treasury report. The Treasury report is, I think, some solutions to some of the problems that regulatorily that we have. And that is the punitive nature of some of the actions taken by some of the agencies, including yours. And so I think it's got to stop. We want to work with you to find ways to increase the ability of these community banks to be able to improve their communities and help their economies grow. And we'll look forward to that. With that, I yield back. Thank you, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes the gentleman from Minnesota, Mr. Ellison.
Good morning, Chairman Yellen. Thank you for being here today. Let me start out by saying I'm really happy about the appointment of Raphael Bostic as president of the Federal Reserve Bank of Atlanta. You know, he meets the legal mandates and he has great expertise, and also, you know, he increases the number of African-American bank presidents from none to one, which I think is important. And so thank you for that. We debate around here a lot of the cause of slower growth over the last several years. You've already been exposed to some people's theories as to why we have slower growth, but I was intrigued by this book I read recently called Makers and Takers. I don't know if you're familiar with this particular book, but it's a book that really talks about the financialization of the economy. And I guess I'd like just to get your take on it. And the author of the book notes that one reason for lower productivity and lower wages is the outsized profits earned by some in the financial services sector, banking, real estate, insurance, hedge funds, Wall Street. And in fact, the author, whose name is Rana Furuhar, and she has a stat up there on the screen that I'd like you to just take a look at. She says that while the financial sector is a little less than 7% of the economy, it provides about 4% of the jobs, but earns a whopping 25% of corporate profits. 25% of corporate profits, like that's a lot of money. And so as a result, you see money flowing into those sectors rather than, you know, plant and equipment and, you know, the other sectors of the economy that might lend themselves to greater employment. You have any take on that? Do you have any impressions about that particular theory?
So the financial sector has grown in importance relative to the U.S. economy, but my sense is that if we look at the plight with respect to wages and jobs of middle-class families that have seen diminishing opportunities and downward pressure on their wages, that we have to take account of factors such as technological change that have eliminated many middle-income jobs and globalization that have reinforced the impact of technological change, and that has to be an important, those things have to be an important piece of understanding what's happened.
Yeah, I'm sure that technology does play some role, but we've always had technology, haven't we? I mean, when we went from horse-drawn carriages to cars, people who made horseshoes had to find something else new to do. So I'm always a little skeptical when I hear people say technology. We've always had technology. We've also had more employment. But we've had kind of this slow growth period, and we've had some people say, well, it's because people don't want to supply labor because they're living too good on welfare. We also, you know, is it possible that the financial services sector is sort of channeling investment into financial, activity and not into agriculture, manufacturing, services that actually employ people? So I'll give you an example. If you look at Sears department store, it's closing about 250 stores this year, and that means thousands of Sears and Kmart employees are going to lose their jobs, and hundreds of communities will lose retail access. Of course, you know, you could point to technology. I'm sure that's part of the explanation, but, you know, can you share some ideas or point to some analysis to explain why the retail sector is being hit so hard? You could say Amazon, but I'm doubtful that that explains the whole problem. Do you have any specific information on the role that finance might be playing in part of these decisions? And did investors demand outsized returns that demanded companies like Sears, fireworkers, sell real estate so that you can have better returns on financial equities?
Well, I don't have anything specifically for you on that. I'd be happy to take a look. I mean, I would point out that for many years, many American companies have been sitting on a lot of cash and have been unwilling to undertake investment in plant at the scale that we would ideally like to see. So I think there are a number of different things going on.
Thank you very much. I yield back my time.
Time of the gentleman has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, chairman of our Capital Markets Subcommittee.
Thanks, Chair Yellen. Sorry, hiding behind a couple of my colleagues here. Let me see. Thank you. Well, it's good to have you here, Chair Yellen. Appreciate that opportunity to have you. And I was not expecting to do this, but I want to touch briefly on something that that Chairman Barr had talked about, the labor workforce participation. These are U.S. Bureau of Labor Statistics, civilian labor force participation rate. This was a study released by the St. Louis Fed. I'm sure you're familiar with it. fred.stlouisfed.org. That was June 17. And it clearly shows that what I heard you say is sort of these disappointing levels of labor force participation are unavoidable because of aging demographic. And I wish I had the chart that I was able to put up, but it seems to me what's most concerning is this drop in participation really comes from youngest Americans. And in fact, that chart, again, released by the Fed of St. Louis, shows the highest levels we have seen since the 1960s for Americans aged 55 and older. And it seems to me this argument that our economy hasn't responded the way that it has. We talked about this actually the last time you were here, and I think I labeled it flim-flam not in a disrespectful way, but it was clearly not what some of those statistics are showing. What I want to talk about, though, quickly is that during your semi-annual testimony before this committee in 2015, you were asked about concerns regarding a lack of liquidity in certain fixed income markets, and you stated that it's not clear quote, it's not clear what is happening in these markets and what is causing what. You continued that, quote, we don't see a problem, but that it was something that you needed to study further. So my question is has there been additional study and follow-up by the Fed on that particular issue?
So that is something that we continue to look at. We provide this committee with regular reports, particularly pertaining to corporate bonds. There's been a number of studies inside the Fed and also outside of it that show no clear pattern, some suggestions that regulations may be negatively impacting liquidity, but other studies reaching different conclusions.
So you don't believe that there's problems in the fixed income markets?
So the inventories of bonds held by some of the largest banks and market makers have declined. On the other hand, bid-ask spreads are low. Corporate bond issuance has been healthy. The market's done well.
But isn't it true that we don't know whether those bid-ask spreads are really there? Because, I mean, there's a lack of transparency.
It is hard to draw conclusions purely based on that.
Well, we're going to actually be exploring this in my capital markets subcommittee on Friday. We've got a hearing on fixed income markets, really just trying to find out what is going on. So maybe we can help you with some of that analysis, with some testimony from here. But we need to have that investigative effort by the Fed on this as well. I quickly want to move on. Former Fed Governor Tarullo suggested in a speech that a, quote, new regulatory paradigm is needed to expand fiduciary duties of directors of banking institutions. He posed the question whether existing modes of financial regulation could be further supplemented by modifying, quote, the fiduciary duties of the boards of regulated financial firms to reflect what I have characterized as regulatory objectives, close quote. Specifically, Mr. Tarullo believed that there is a, quote, special corporate governance measures are needed as part of an effective prudential regulatory system, and he argues that traditional fiduciary duties focused on shareholders are inadequate for banking institutions. So we're not talking about DOL or any of the other fiduciary side of this. This is for banking institutions. Do you agree with his recommendations?
Well, those are his personal recommendations.
So is that a no?
I'm not prepared to say that I agree with all of those recommendations. We're focused on trying to clarify expectations for boards of directors to distinguish what the important role that they have in a banking organization, and what is the job of senior management versus a board of directors.
That would be a concern that I have here is what expertise the Fed has on corporate governance issues like fiduciary duties of corporate boards, and under what, frankly, under what legal authority does the Federal Reserve seek to preempt state corporate governance requirements, as well as another number of things. So I appreciate your answer, and thank you for being here.
Time of the gentleman has expired. The chair now recognizes the gentleman from Colorado, Mr. Perlmutter, ranking member of our Terrorism and Illicit Finance Subcommittee.
Good morning, Madam Chair. And thank you for being here, and thank you for being a steady hand at the Federal Reserve. And you must be doing an okay job, because I've listened to my friends, my Republican friends, who generally have very crisp, sharp, piercing, probing, and accusatory questions. They don't have those today, because things are doing pretty well. In Colorado, I want to thank you. We were in real dumps 8 years ago. 10% unemployment, housing crashing, foreclosures through the roof. In my district, we're at 2.1% unemployment. The state generally 2.3%. And I know that's not the same for, some of the parts of my state a little tougher, and I know across the nation. But generally, things have been steady, and I want to thank you and the policies of the Fed in helping us get out of what was a very bad situation.
Thank you for that.
So, a couple questions. First, there's a guy who has been pretty dogged in wanting to telling me that we need to shrink the Fed's accommodative policies. And pretty much, and he's in the audience today. So explain to me, he's right directly behind you, a couple rows. And he's been very firm over these years in wanting me to press you on this. So would you explain to me how you plan to shrink the accommodative policies that we took back in 2008, 9, and 10?
So the Federal Reserve was dealing for many years with an economy with very high unemployment and inflation running below our 2% objective. We did everything that we possibly could to try to achieve the goals that we've been assigned by Congress, namely maximum employment and price stability. We were constrained in our ability to use short-term interest rates as a tool, and so we used our balance sheet and undertook other measures to try to stimulate the economy. And I believe we've been succeeding. While inflation is still running below our 2% objective, the labor market, as you pointed out, is much healthier. The unemployment rate is now even running a little bit under levels that we regard as sustainable in the longer run. I think that's entirely appropriate, given that inflation is running below our objective. So as the economy improves and we come closer to achieving our objectives, we see it as appropriate to begin to gradually remove accommodation and move to a neutral stance. As I've said on many occasions, the new normal with respect to what level of interest rates is neutral appears to be rather low. So we have raised the federal funds rate target. I believe policy remains accommodative, but given how low estimates of the neutral federal funds rate are now, namely levels of the funds rate that would just be consistent with sustaining a strong labor market over time, we, perhaps have some further moves that we envision making if the economy proceeds along the path it's on. We anticipate that neutral may move up some, although remaining at low levels. And that generates a view that over time we may want to increase the funds rate a bit more, but that all really depends on how things evolve. So
let me change the subject real quick. And on page 12 of the report, there are two words that I've never seen in any of your reports, and it's abysmal performance. And it's as to productivity developments in the advanced economics. That's the section. And the combination of technology and advances in science and everything else, coupled with labor, we're seeing something. So it's in the second column. A number of potential explanations have been put forth for the abysmal performance of TFP, that there's a waning, oh, well, I'm out of time. I thank you for your service. You're doing a heck of a job. Thank you very much.
Thank you very much.
Time of the gentleman has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, chairman of our Housing and Insurance
Thank you, Mr. Chairman.
Committee.
Welcome, Madam Chair. My friends across the aisle seem to be relatively excited about lower unemployment, an economy that's picking up, excited that the stock market and people's 401ks are improving, and they want to give you a lot of high fives and backslapping. You get all the credit. What changes have you made since November 8th to kickstart this economy and make it grow that you weren't doing before November 8th?
What changes have we made to kickstart the economy?
Yes.
We've continued on the course that we've been on of normalizing the path of monetary policy as the economy continues
So you haven't
to
changed
recover.
anything really since November 8th. The real change has been we have a new president in the White House. I just make that point to my friends across the aisle to not get too excited on who should get credit for an improving economy. But I do want to follow up on what my friend Mr. Huizenga was asking about, the gentleman from Michigan, in regard to the role that the Fed is playing on corporate boardrooms and our financial institutions. You'd acknowledge you do have a role at the Fed in these boardrooms. What role do you have? What are you doing?
Well, it's our job to make sure that banking organizations operate in a safe and sound manner and have policies in place that ensure both their safe and sound management and compliance with federal laws and regulations. And corporate boards play a critical role in ensuring the performance of financial institutions.
Isn't it fair to say, though, that virtually anything could fall under the umbrella of safety and soundness? I mean, who is hired and who is fired and who is disciplined within a financial institution could fall under safety and soundness, right?
Well, I think it's important to, and we're going to try to do this.
That could fall under safety and soundness, right?
Yes, it could.
And how capital flows, who a financial institution lends to could fall under the auspices of safety and soundness, right?
Yes, it could.
I mean, in essence, the Fed, under the auspices of safety and soundness, could replace the board of directors who have a fiduciary duty to shareholders and actually take over boards, all under the premise of safety and soundness.
Well, we believe that corporate boards play critical roles in ensuring.
What falls outside the scope of safety and soundness in a financial institution? Exactly.
Well, probably anything that you mentioned would have some.
You can't give me an answer because everything falls under that scope, and that's our concern. The Fed doesn't have a fiduciary duty to shareholders. And actually, board members have potential civil and criminal liability in their service on a board. Does the Fed have any civil or criminal liability should things go wrong on a corporate board? So board members are liable. How about the Fed?
Well, we have supervisory responsibilities.
No, you do, but are those Fed members who are sitting in on board meetings, are they potentially criminally or civilly liable for the decisions that they push a board to make?
Not to the best of my knowledge.
Mine either. That's concerning for us. And listen, I'm pushing you on this because, listen, you do have a supervisory role, and I want you to do a good job. But from the feedback that we get, the involvement that the Fed has in our corporate boardrooms has far surpassed I think, the vision that any of us had in this room, and it concerns us.
So let me say that we've talked to many corporate board members and understand that there has been an accumulation of a large number of items. We have indicated that board members, along with senior management, should be responsible for.
I don't believe you have the authority,
we
Madam
should
Chair. I don't believe you have the
clarify.
authority to make hiring and firing decisions, and that's the feedback that we have had from members. My time has almost expired. If I could ask you one last question. Do you anticipate that this will be your last time testifying before this committee?
My term expires in February, and so
It's a roundabout way of asking you.
may well be.
Are you seeking another term?
I not said anything about that. I intend to serve out my term and not.
And though we push you hard, I want to thank you for your service, and I yield back. My time has expired.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Illinois, Mr. Foster.
Thank you, Mr. Chairman and Chair Yellen, for your service. In the past, I've sent letters to you and other federal regulators and asked you in hearings before about the requirement that custody banks hold supplementary leverage ratio against deposits at the Federal Reserve, presumably because of worries that in some future universe, the Fed deposits may become less safe and available than cash, which is a universe I don't enjoy contemplating. I believe that the Federal Reserve deposits are exactly the sort of safe place for these large, immediately callable cash positions that we should actually be encouraging because of the strength and reliability of the Federal Reserve as a counterparty. Now, as you may be aware, we now have bipartisan legislation to require that prudential regulators provide relief for institutions that place cash with the Fed, at the same time as providing significant flexibility for the regulators to deal with unusual circumstances. So do you see any safety and soundness difficulties if this legislation were to go forward?
So I'm not going to comment on the legislation, but we are looking at the supplementary leverage ratio because of the impacts that you mentioned. A leverage ratio is meant to be a backup supervisory device calibrated appropriately relative to risk-based capital requirements. And while in general, I think risk-based capital requirements, especially for the largest and most systemic institutions, are at levels that I think are appropriate and I'm comfortable with, it may be that the supplementary leverage ratio needs to be recalibrated relative to that, and I'm very much aware of the problems that you're mentioning, and we're considering how to address them.
Thank you. And I'd like to use a little of my time to just comment briefly in defense of my home state of Illinois in response to some of the remarks from my colleague from New Mexico. Every year, the citizens of Illinois write a check for approximately $40 billion to states, largely in the Sun Belt and rural areas, because for every dollar of tax money, Illinois receives back only 75 cents of federal spending. In contrast, New Mexico receives $2.40 back for every dollar of tax money. And so this check that we write for $40 billion a year, had it been put into a rainy day fund instead of redistributed to other states in the union, would have resulted in a balance in that rainy day fund in excess of $1.5 trillion today. And so that I think that when people discuss the fiscal problems of Illinois, the starting point should be there. Now, I'd like, finally, I'd like to, I co-chair a future work task force for the New Democrat Coalition. And then we're looking at the effects of technological and other changes that might occur in our workforce in the coming years and what policies we should adopt to remediate the bad side of those effects. There's a lot of discussion now about why inflation is not increasing as you would have guessed in the past, particularly wage inflation. In the past, when the gap closed up in the job market, that very rapidly employers would start bidding up wages. That doesn't appear to be happening the way it used to. And one of the explanations that is suggested for that is that employers have the opportunity, instead of just bidding up wages, to simply invest in technology that replaces jobs. I was wondering if you think there is a reasonable chance that you're going to have to change your macroeconomic models to reflect the loosening of the link between the closeness of the tightness in the job market and the increase in wages.
Well, we are seeing attenuated links, I think, between the labor market and wages, but even to a greater extent, prices and inflation. The relationship between those two things has become more attenuated than we've been accustomed to historically. And it
well, in general, when the robots show up, they show up as low prices. If you ask the average farmer, what forced them to consolidate, they don't say it's the machines, they say it's low grain prices. And that goes on in many ways. Retailers are struggling with price competition from Amazon. They don't often name, well, we're not as efficient as the robots in Amazon distribution centers and so on. So I think that really we have to look at this in a macroeconomic sense because its effects will not be small. And I encourage you to think about that.
Thank you.
Time of the gentleman has expired. Chair now recognizes the gentlelady from Missouri, Ms. Wagner, chairman of our Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman. And Chair Yellen, our committee has been concerned for some time about confidential FOMC information being shared with favored constituents. In March, Vice Chair Fisher delivered the keynote for a Brookings Institution dinner and reportedly delivered remarks and took questions on interest rate policy. I say reportedly because the dinner was closed to the public and the press, but open to Wall Street and other financial interests. In addition, Fisher's prepared comments have not been made available, and the fact the speech took place, frankly, at all was not widely known. This keynote flies in the face of the FOMC's policy on external communications of committee participants, which states that, and I'm going to read this right out of the policy, quote, committee participants will strive to ensure that their contacts with members of the public do not provide any profit-making person or organization with a prestige advantage over its competitors. They will consider this principle carefully and rigorously in scheduling meetings with anyone who might benefit financially from apparently exclusive contacts with Federal Reserve officials and in considering invitations and to speak at meetings that are sponsored by profit-making organizations or that are closed to the public and the media, close quote. Chair Yellen, we all want transparency and accountability for our monetary policy so that it remains insulated from political and profit-making interests. The Vice Chair's speech does not help with that at all and flies, in fact, in the face flagrantly of policy. This speech occurred just days before another Fed official, Jeffrey Lacker, abruptly resigned as Richmond Fed president after admitting to playing a role in the 2012 FOMC leak, where market-sensitive details of the central bank's internal deliberations were leaked to a private consultant that then shared the details with clients who stood to net millions in profits by trading ahead of the release of the news. However, the true leaker still remains at large, apparently, as former President Lacker appears to have only incidentally confirmed insider information that Medley had already received. This is something that I, certainly as chairman of the Oversight and Investigation Subcommittee, will continue to look into. Chair Yellen, how could this speech have been allowed to happen, given everything that had occurred with the 2012 FOMC leak?
Okay, so let me start by saying that the very beginning of our policy on FOMC external communications states that two-way communications between members of the committee and members of the public are very important, both to communicate with the public and also to gain information, and that these will occur in a variety of ways, including in some closed-door meetings. So there is no requirement that FOMC members cannot meet in closed-door sessions. The Brookings Institution is not a for-profit institution. It's a nonprofit, and we have a clear set of guidelines governing what can and cannot happen in such
Will the
closed-door
remarks be
meetings.
released to the public?
So the clear rules are that no FOMC confidential information can be divulged ever, including in a closed-door setting, and that FOMC officials may not discuss even their own views on policy except to the extent that they've already been presented in a public forum.
So Wall Street...
The Vice Chair's remarks did not pertain to monetary policy. They pertain to financial
The difficulty,
stability.
and reclaiming my time, Chair Yellen, the difficulty with this is that we don't know that. And in the interest of transparency and accountability, perhaps it would be good to show the light of day on whatever his remarks were to Wall Street bankers that were invited to a speech at the Brookings Institute. And I have to say, Madam Chair, that you know, it's very clear that these should not be closed to the public or the media. So I'm very concerned about this going forward, and I'm also concerned about the resolution with the board due to the internal governance that happened on the FOMC leak. So I'd like to submit that in writing and get your information on that. Thank you, Mr. Chairman. I'm sorry.
So I want to say that we have cooperated fully with our Inspector General and law enforcement agencies, that they've had access to all information that's relevant to this matter, and that they announced simultaneously with President Lack's
The board must improve its standards and keep to its standards, Madam Chair.
Time of the gentlelady has expired. Chair now recognizes the gentleman from Missouri, Mr. Clay, ranking member of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman. Thank you, Chairwoman Yellen, for being here. You know, perhaps we should replace some of the fantasy that we've heard today on the other side with the reality. You know, I hear my colleagues over there say that within 6 months of this new administration, we have improved the economy, we have improved employment opportunities for Americans. I guess they're pointing to the carrier deal in Indiana, where they were promised over 1,000 jobs to stay in this country, and about 750 we hear are moving to Mexico. But we'll give the president credit for that deal. And really, I know that the reason why the economy is turning around is the sustained job growth of the previous administration over more than 6 years. So here's my question to you, Chair Yellen. In May, the overall unemployment rate of 4.3% hit a 16-year low. Although the unemployment rate rose 0.1% in June, this reflected the positive news that more workers who had dropped out of the labor force had returned to look for work. With the overall rate of employment now down at historically low levels, would you say that the economy has reached full employment, or do you believe that this headline rate masks weaknesses in the labor market where additional progress must be made?
So not all groups in the labor market are faring equally well, and we remain concerned about, particularly for African Americans and Hispanics, weaker job market outcomes. But monetary policy is a blunt tool. As you point out, the unemployment rate and overall state of the labor market is strong, with many job openings and opportunities for workers. So the unemployment rate has even fallen slightly below levels that my colleagues would regard as sustainable in the longer run. We have seen a steady rate for several years now, a constant rate more or less of labor force participation, which with an aging population tending to push it down, suggests that groups that have been sidelined are finding opportunities and entering the labor force and gaining employment. So that's a strong performance, and this has now been going on, as you said, for a number of years and has continued, is continued this year.
Yeah, and thank you for that response, because progress doesn't happen in 6 months, especially when you have to recover from a devastating recession. And so for the other side to give credit to someone who's not even focused on our economy is ridiculous. Now, one more question. What, in your view, have been the key drivers of the job gains since your last testimony before this committee 6 months ago? Have job gains been driven by longer-term trends from a growing economy, or have they largely resulted from new policies adopted in recent months?
So the global economy has recovered. It was a source of weakness earlier. That's been a source of support, and we've had ongoing job gains and increases in, for example, housing prices that are boosting the wealth and consumer sentiment of Americans, and that's driving consumption spending that's strong enough to create ongoing job gains that exceed what's needed for an expanding labor force. So the job market continues to strengthen and unemployment continues to move down.
And thank you for that response. I hope this is not your last visit to this committee, but I'm sure it won't be the last time we visit. Thank you, and I yield back.
Gentleman yields back. Chair now recognizes the gentleman from Florida, Mr. Poe.
Thank you, Mr. Chairman. I get into the cat fight or dog fight of who shot John and whose policies are doing what. And I heard the remark that, you know, the economic analysis cannot show any significant short-term results or something to that effect. And I'd just like to remind the other side that I saw dramatic overnight change in the stock market from the election to the inauguration. And I think we'll go on. Chair Yellen, good to see you again. Since I arrived in Congress, the most co-sponsored, bipartisan, significant piece of legislation has been Dr. Paul's original legislation to audit the Fed. We've passed it, but it goes nowhere at the other end of the building. Are you afraid of getting that passed?
I'm strongly opposed to audit the Fed. What audit the Fed is audited in every way that normal Americans would regard an audit. Our financial accounts and holdings are public.
It's not audited like all other agencies. You're aware as well as I am of the list of exemptions to the Fed.
The Fed removes exactly one exemption that the Federal Reserve enjoys, which is real-time policy reviews by the GAO of our monetary policy decisions, and that is the essence of Federal Reserve independence and trying to keep politics out of decisions that should be technical, professional, and nonpartisan.
Well, I'd agree if I thought there was a lot of truth to that statement, but auditing something after the fact has nothing to do with influencing the decision, I wouldn't think. I would consider it an important matter, actually, of transparency, and I, for the life of me, cannot understand what the Fed fears. Can you give me an example that would justify the lack of transparency?
Well, we don't have a lack of transparency.
You do. If you can't audit it, that's a lack of transparency. To most people, I know it's a lack of transparency. To some people, it may not be, but I don't understand that. That's the reason I'm questioning you about it.
So I regard the Federal Reserve as one of the most transparent central banks in the world.
That's a statement. What do you fear about the audit. Give me a real-time example.
So I think the FOMC needs a space in which it can have honest conversations and deliberate in real time about the decisions that we make without having political influence brought to bear in second-guessing decisions that we have made and opining on them, possibly with the idea of reversing them.
You know, we can discuss things in public that are sensitive, talk about national security. The Supreme Court does the same thing. You know, they don't worry about the transparency influencing them. Just give me an example. Give me an example of how transparency could hurt the Fed. Just give me one example how it could hurt the Fed being transparent.
Because what you're talking about with the GAO are policy reviews.
Just, no, give me an example, not a general swipe of review. Just say, take, for example, this. If somebody said this, it would be horrible. It would be end of the world for the Fed. Give me an example like that.
So I would envision a situation where the GAO, at the request of members of Congress, might come in and say, at our meeting a week ago, they've taken the transcripts and reviewed what we said. They believe that the decision we made was the wrong one at that particular meeting. And I would say that's an extreme interference and politicization of our ability to make independent monetary policy decisions.
So you're telling me we shouldn't be transparent for the fear of being second-guessed or somebody criticizing you because they thought you were wrong. Yeah, do I get it?
What we're talking about is political interference in decision-making by the committee.
I don't see that. If it's after the fact, I don't see the interference in decision-making.
Well, I do, so I
Well, give me an example.
I gave you an example.
Just give me one example of why they shouldn't have that transparency.
Well,
time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you very much, Mr. Chairman. Chair Yellen, welcome. Good to have you again. Chair Yellen, I first of all want to thank you and the Federal Reserve under the leadership of our ranking member, Ms. Waters, and ranking member Judiciary John Conyers, and myself, and others. We were hopeful that for the first time in history, American history, that the Federal Reserve would appoint and hire the very first African-American ever to hold the position as a regional president of the Fed. And you all did that. And we want to say thank you so much. We deeply appreciate that. That means a lot, not just to the African-American community, but to all Americans. That's what this great country is about. Now, let me go to one other thing. Chair Yellen, let me talk. You and I have had ongoings about, of course, the high unemployment rate of African Americans. And I always remember fondly when you referred to that as a blunt instrument. As I said, that's what M said to James Bond to describe him. In other words, he couldn't go through it. So you said that Congress had to come up with some legislation. We did that. House Resolution 51 and 52, of which we sent a copy to you, you know, which would tie African America's staggering unemployment rate of African American young men in the inner city to apprenticeship training programs attached to rebuilding the crumbling infrastructure. That has been introduced. And of course, each 5 years, we have to, by law, fund the 1890s African-American colleges. So we put $95 million in the appropriations, hopefully, that we will be able to spread over for 5 years at $5 million for each of these universities over that period. Now, I read your past reports that you have given, and you have talked about housing, and we'd like to move to that next. And in your past 3 reports, you made a point to dedicate full sections of the report to specific topics related to the disparity that the Federal Reserve is seeing in the data for the African American community. So I want to call your attention specifically to those sections from the 3 most recent reports to Congress. The titles of these, and you referred to them as boxes, if you recall, boxes. That's what the Fed calls them. And one box was, have the gains of the economic expansion been widely shared? Box number 2, home ownership by race, ethnicity. And box number 3, does education determine who climbs the economic ladder? And in that discussion of those problems, you included socioeconomic differences between whites and blacks, poor credit scores due to income disparities, and continued discrimination. That lays it bare. So, Chair Yellen, let me just ask you, of all of these factors in your boxes, which of these factors is most pressing, and what recommendations on substantive solutions can we in Congress work on to help address the home ownership problem hurting African Americans, much as you suggested that we develop this legislation that's moving forward on the unemployment of African Americans?
Well, I don't want to try to give you detailed suggestions for what legislation you can put forward. Our job is to try to do the best we can to provide information and background that will be helpful to you as you decide what's appropriate. Yeah. And I do believe this is squarely in the domain of Congress and the President, and we're trying to provide useful information.
Absolutely, and we will pursue that. I commend you for bringing that up, and I would love for you to stay on in your position as Chair Lady of the Fed.
Time of the gentleman has expired. The chair now recognizes.
A chance to speak to Mr.
The time of the gentleman has expired.
I will mention that.
Time of the gentleman has expired. The chair now recognizes the gentleman from New Jersey, Mr. MacArthur.
Thank you, Chair Yellen, down here, over here. Hi there, welcome. I want to thank you for your service to our country, and I appreciate you being here today. Your testimony has been helpful to me. I had 2 areas I wanted to explore. One is non-bank SIFIs. My state, New Jersey, in 2014, authorized by legislation our Department of Banking and Insurance to do group supervision of insurers that were involved in the international marketplace. And I know that FSOC under Dodd-Frank, when it reevaluates SIFI designations annually, is required to consult with state regulators. And I wanted to get a sense from you of how you would view now a state insurance department doing regulatory work of a group insurer. Does that impact, in your view, how FSOC might look at the SIFI designation of an insurer?
So this is a matter for FSOC to decide. We have met with state regulators in New Jersey, and I'm aware of this development, which is a heartening one. I would say that the FSOC's focus in designation is the systemic risk that the failure of a given entity could pose to the broader financial system. To the best of my knowledge, most state regulators focus in supervision on protection of policyholders, which is, of course, a very important objective, but not on the systemic risk that the activities of a company could pose to the broader financial system. And so in considering this matter, FSOC would, I think, have to take account of what the focus of that holding company supervision would be.
Okay, I appreciate that. Although I would add, as just somebody who spent a lifetime in insurance, I think state regulation has proven to be, when you regulate individual companies within a group, you create a safer company, and I think our system is better than the European system, which focuses on the group, not the company. But that's another matter. The other area I wanted to explore with you was the labor participation rate. You have mentioned it twice today, and each time you've said that our aging population is pushing it down. And I guess on the one hand, that makes a certain amount of intuitive sense. We have a baby boomer bubble working its way through. But I did want to ask you about a few particulars with that. Does the Fed use the Bureau of Labor Statistics data on labor participation?
I believe that's the core data.
That's the core data
we have on.
So I have the Bureau of Labor Statistics employment data on my iPad. I'm looking at it. Unfortunately, I didn't do it ahead of time, so I can't put it on the screen. But when I look at the actual data, all people over 16 years old, so basically everyone who's of working age, that has gone, labor participation rate has gone from 66.6% in '94 to 62.9% in 14. So it's a 3.7 percentage point decline in labor participation. And you've suggested that's because people are getting older and, they're dropping out of the workforce. But that's not what this chart says. What it says is that 65 and older has actually increased from 12.4% in '94 to 18.6%. That's a 6.2% increase in that 20-year period. Let me just finish the question. For that group, and then for 55 and older, which is broader and includes those of normal retirement age, that number's gone up by 10 percentage points. The one that's gone down, the group that's gone down is the 25 to 50-year-old. They've declined from 83.4% participation to 80.9% participation. That group, the 25 to 54-year-old group, peak earning years has declined by 2.5%. 2.5% times 324 million population is 8.1 million unemployed people in peak earning years. It doesn't seem to square with your assertion earlier twice.
So very quickly, it is true that people in the retirement years 65 and older are working more now than they used to, but the level of labor force participation of that group is dramatically lower than of prime age workers, and an increasing share of the population is now moving into those years with low labor force participation. So there's no conflict between the number that you cited and my statement that an aging labor force
my time has
time of the gentleman has expired.
It is also true
time of the
that
gentleman has expired.
Participation of prime age workers
Chair,
has declined.
the chair now recognizes the gentleman from California, Mr. Sherman.
Thank you, Madam Chairman, for coming here. Every few months, I remind you that you have not yet used your authority to break up the too-big-to-fail institutions. And I will spend the next minute reminding you, they are too big to fail. If the entity, just one entity, goes down, it could take our whole economy down with them. They're too big to compete against because economic studies say that that investors and the markets assume that they will be bailed out. They've seen that Congress will pass new legislation to bail out if that is thought necessary to save the economy, and that therefore they're able to get a cost of funds that may be as much as 80 basis points less than they would otherwise. They are too big to jail, as former attorney generals have said they wouldn't criminally prosecute because it might take down the whole economy. They're not, you know, if the same thing was done by a medium-sized bank, no economic problem, go ahead and prosecute. And then with the Wells Fargo debacle, we have a difference between Republicans and Democrats. Democrats tend to blame the management of Wells Fargo and say that that proves they were too big to manage. And Republicans tend to blame you, the regulators, which just proves that they were too big to regulate. So too big to fail, too big to compete against, too big to jail, too big to manage, too big to regulate. When a protozoa gets too big, it is able to split into two healthy cells. And I would think that the geniuses on Wall Street would have the same, at least the same level of intelligence as the average one-celled aquatic animal. Every time you come here, you're attacked by those who criticize the low interest rates that we've had in our economy. Now, with low interest rates, you get more economic growth, but you might also get more inflation. Over the last 5 years, has rampant inflation been a disastrous difficulty for the American economy?
Inflation has been running under our 2% objective for the last 5 years and continues to do so.
And I won't even ask you this question because it's so obvious. Has economic growth been too robust? I don't.
It has not been particularly robust, but it's been sufficiently robust to create a lot of jobs and drive down the unemployment.
But every day, every time you come here, you're told that the interest rates are too low, but you're also criticized because the economic growth has not been robust enough. Now, behind you, at the request of the majority, is the national debt clock. The majority always comes and tells you that you should shrink your balance sheet. That you should sell off your assets. Of course, you in effect are lending money for longer terms and borrowing money for shorter terms, or just printing it one way or the other. And you create a tremendous profit for the federal government by having a big balance sheet. So people want you to have a small balance sheet when your big balance sheet is creating a lot of profits for the federal government. Have any of the advocates for a smaller balance sheet proposed to you the taxes they want to increase in order to replace the profits that you're earning on the balance sheet that they're telling you to shrink?
It is certainly true that our large balance sheet has resulted in very substantial transfers to the Treasury and to the federal budget. Let me say, our objective is not to make a profit and to maximize those transfers, but rather to do what is right in the pursuit of our objectives. But
I would say that the millions of Americans who want us to run the federal government more like a business would say that perhaps profit should be thought of as an important objective. And I'll take your answer as that you have not heard any proponent of a smaller balance sheet put forward a tax increase proposal designed to replace those revenues or to keep that clock behind you from turning more quickly. Finally, we want businesses to do things that require longer-term capital. You tend to focus on short-term interest rates. What has your big balance sheet done to decrease the gap between short and long-term interest rates, the yield curve?
We purchased those assets to drive down long-term interest rates relative to short, or to flatten the yield curve and lower longer-term borrowing rates.
And so the proposals are to make it more difficult to borrow money long-term.
That's correct.
Time of the gentleman has expired. The chair now recognizes the gentleman from Tennessee, Mr. Kustoff.
Thank you, Mr. Chairman. Thank you, Madam Chair, for appearing this morning. In the next hour or so, when this hearing ends, if you were to receive a call from the President telling you that he intended to nominate you for another term, would you accept?
That's something that hasn't been an issue so far. It's not been something that's come up, but I would certainly something that I would discuss with the president, obviously.
Thank you. Yesterday, when I asked you about comments that Jamie Dimon made as it relates to assets coming off your books, you've stated here today, and you've stated in previous reports, that the Fed does intend to reduce its the balance sheet, the assets off the balance sheet. I would like to ask you first, before I ask you about Mr. Dimon, if you could address the timing of when those assets will come off the books, the amounts, and procedurally how that will be done.
Yes, so we've tried to set out a relatively complete plan. Our assets currently total close to $4.5 trillion, consisting of roughly $2.5 trillion of treasuries and 1.7 of mortgage-backed securities. We've said that we intend to shrink our balance sheet, and particularly the outstanding quantity of reserves in the banking system, which are now around $2.2 trillion, in a gradual and predictable way. And we have said that what we intend to do is, once we begin this, as we receive principal payments on treasuries and the agency securities in our portfolio, currently we're reinvesting all of those principal payments. We will begin to diminish our reinvestments and only reinvest to the extent that our monthly receipt of principal exceeds a cap. The cap will initially start at low levels, $6 billion a month for treasuries and $4 billion a month for mortgage-backed securities, and over the space of a year will ramp up to $20 billion for mortgage-backed securities and $30 billion for treasuries. So after a year of this process running, the caps will remain in place, but bind only infrequently when there are unusually large redemptions of principal that take place. And we've not decided yet on what our longer-run monetary policy framework will be and what quantity of reserves that will entail are supplying to the banking system. We expect it to be substantially larger than pre-crisis, but substantially less than we have now. And I would say this process will play out probably to around 2022, when our balance sheet would probably somewhere in that range shrink to normal levels. Now, currency, since the crisis, currency has more than doubled in quantity, from about $700 billion to $1.5 trillion now. So our balance sheet will end up substantially larger than it was before the crisis, but appreciably lower than it is now. And then over time, when this process is complete, if currency in circulation continues to grow, our balance sheet would likely grow in line with the overall economy.
I think you probably saw the comments yesterday from Jamie Dimon, chairman of J.P. Morgan Chase, about his concerns about assets being moved off the balance sheet. Do you share those concerns?
Well, we've tried to be very methodical about informing the public and the markets about how we're going to do this. We've provided essentially complete information. We've not heard significant concerns or seen a significant market reaction. So we've indicated we expect to begin this if the economy stays on track this year. I expect and certainly hope that this will go smoothly and it will be a gradual and orderly process, one that we will not be revisiting on a regular basis. It's something that we will run. It'll be understood and play out over time. So obviously we will watch what the market impacts of this are when we put it into effect, but I expect this to play out smoothly. It's certainly my hope and expectation.
Time of the gentleman has expired. The chair now recognizes the gentleman from Michigan, Mr. Kildee, the vice-ranking member of the committee.
Thank you, Mr. Chairman, and thank you, Chair Yellen. It's good to see you. Glad to have you back. As you may recall, and I'm sure some committee members recall from previous discussions, I sort of consistently raised this issue of older industrial cities, the condition of older communities, a subset of American cities that are continuing to struggle. In fact, I'm launching an effort actually beginning today with a discussion at 2 o'clock entitled The Future of America's Cities and Towns, specifically to raise more attention around this question. And we've talked in the past about the role that regional banks might play in working with these particular cities that face both economic challenges, but specifically the cities that face fiscal stress. The thing that I'm concerned about is that when we look at aggregate data, even with relatively slow growth in the economy, the assumption is that even a slowly rising tide raises all boats. Well, it does not, and we know that. And so the question I have that I'd like you to comment on, perhaps, is what policies the Fed might engage, and to the extent that your mandate regarding employment is also affected by policy that we make, what are the sorts of initiatives that you think should be engaged, both by the Fed and by Congress, to help deal with this real disparity which continues to grow? And I'll just underscore this point by saying there are a whole set of American cities that are really struggling, both in terms of the growing unemployment, increased poverty, lack of opportunity, low educational attainment, aging infrastructure, fiscal stress in these cities where we're going to see bankruptcies or at least insolvency. If the states won't allow those communities to go into bankruptcy, they're still insolvent. These are communities that have high concentrations of minority populations. And you note in your testimony the disparity that those particular communities face. And this is not some sort of accident where just by bad luck a bunch of communities are struggling. It's a result of policy. And I wonder if you just might comment on what you think the Fed can do and what Congress can do to help achieve not only growth in terms of employment and wages, but greater equity in terms of how those areas of growth might be shared.
So the Federal Reserve, and particularly the reserve banks around the country, play an important role in doing research on community development and try to understand and publicize what kinds of strategies seem to work. Of course, we play a role in the Community Reinvestment Act, which financial institutions are looking to ways for effective ways of promoting development. A number of reserve banks have looked specifically at older industrial cities and tried to study, and we have volumes that have been published on this. The Boston Fed in particular has been very active in trying to understand what strategies have been effective in older industrial cities in regenerating activity in dealing with these problems. And of course, they're complex, but there are workforce development programs and collaborations between governments, local governments, state governments, nonprofits, businesses that have been singled out as ones that appear to be promising. But of course, these are very difficult issues, and Congress and policymakers outside the Fed may have a role. Ours is mainly research and trying to disseminate findings that we have.
I appreciate that. And I've, in my past work, worked with the Philadelphia Fed, Cleveland, on these issues. I wonder if you might just, in the final few seconds that we have, comment on policy that Congress might enact, basically around budgetary policies that we have in place. I'm really concerned that that's an area where we may undermine not only your mandate, but also our own work. In the 1 second remaining.
I'm not going to give you detailed advice on fiscal policy. I think focusing on policies that promote productivity growth and stronger economic growth should be near the top of your list.
I thank you, and I appreciate you coming back again.
Time of the gentleman has expired. Chair now recognizes the gentlelady from New York, Ms. Tinney.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for being here today and also for your service to our country. I'm going to touch on exactly the same issues that my colleague just touched on, and it sounds like our districts are very similar. I come from upstate New York, a very highly agriculture area, but a place that has seen better days in terms of our economy. We once had many, many community banks, and I might quote a very interesting comment that was made by President Trump in his inaugural address in describing our manufacturing landscape. And he described it as rusted out factories scattered like tombstones across the landscape. And you can look at our community banks much the same way. You can go to just about any corner in any suburban or small city area in my district and find community banks closed and overgrown with grass and not operating and empty, where they once were providing great resource to our community, our small business community. 50% of the small business loans are made by community banks. 77% of agricultural loans are made by small community banks and credit unions in our community. And agriculture is still the #1 industry in New York State, believe it or not. And what I see, and very similarly, I think this mirrors what's been going on in the business community as well as the banking community, as you provided in your prior comments to my predecessor speaker, that you think that a lot of government programs can help this, and taxpayer money may be spent for work revitalization. But I'm suggesting possibly the free market, since in New York State, we spend 4 times more using taxpayer money and so-called cronyism on producing jobs, and have the worst job production record in the nation, the highest outmigration of jobs and the highest outmigration of people because of our regulatory burden. And I thank you for indicating earlier that you do think that there are some ways that we can reduce regulations on some of these banks, especially the smaller ones who can't compete because of their compliance requirements. We now have the growing cybersecurity issue where that's becoming very costly and burdensome. Obviously, lending to mortgages and to personal loans are very difficult. You indicated earlier that you would support the Treasury's release that certain regulatory relief is in order. Could you tell me a couple of those recommendations that you would support in reducing regulations to help our small community banks and credit unions?
So I am very supportive of trying to reduce the burdens on community banks. We have suggested that community banks, there are things that Congress could do to help reduce burdens. For example, Volcker rule and incentive compensation.
Are you saying that you would eliminate the Volcker rule for small community banks?
Wouldn't apply it to community banks.
And where would you make that cutoff? Would it be something you would be interested in using overall, eliminating the Volcker rule, or just where would you make that arbitrary decision on what makes a small bank?
We could discuss that. Yeah. I don't have
So you don't have an idea in mind where we could actually do that? I'd love to know. I mean, honestly, I'm asking your...
I mean, I'd prefer to get back to you on...
Okay, so we don't have a specific cutoff.
But I think there's a lot that the banking regulators can do on their own. We've finished an AGRIPA review. The banking regulators are committed to addressing concerns of community banks about the complexity of capital regulations, to come out with a simplified capital regime. We've recently cut reporting requirements for community banks. We're trying to extend exam cycles and to tailor the work that we do so more of it is done off-site in ways that are less burdensome to community banks, and to risk focus our supervision so that we're focusing in our exams on the areas that are really of greatest risk. So we have a long list of suggestions coming out of the Agrippa review.
Could you tell me what, so you indicated there were some that earlier you testified that these are some of the ones you would support. Which ones wouldn't you support that are recommended by Treasury, as you indicated?
So I don't have that list before me.
Okay.
I just, let me say in general, that's an area of the report that we are quite supportive of. So I'm not, you know.
But definitely the Volcker rule, at some point, you'd like to eliminate that, especially regarding community banks.
Yes.
Can you give me an estimate about where the capitalization requirement would be to eliminate it?
What we would try to do is simplify requirements for things like commercial real estate, high volatility, commercial real estate that community banks have found very complex, or tax-deferred assets or other capital instruments that have resulted in complexity.
Time of the gentlelady has expired. The chair now recognizes the gentlelady from Ohio, Ms. Beatty.
Thank you, Mr. Chairman and Ranking Member, and thank you, Chairwoman Yellen. Let me just first take a point of privilege to thank you for all of your work and tell you what an honor it is for me to have been in Congress at the time that I could sit here and ask questions of you. And secondly, you will hear throughout all of our hearings colleagues oftentimes referencing that letters were written and 30 days had gone by, or months, or they did not receive an answer. Well, I want Mr. Chairman and Ranking Member to enter into the record that every single letter I addressed to you, I got a response. And not only did I get a response, I got a note or something attached with it from a staff person, and one, I believe, was actually your thanks. So I think it's important because so often we criticize those, and I support colleagues on either side when someone does not respond to us. So I wanted to say thank you. I'm going to be consistent. But I am going to use some words I had not intended to use, but after my colleague from New York, Congresswoman Tenney, used the word finding common ground, I want to thank her for that, and I'm going to start with common ground. I think it's important when you represent a subset or you have a background, which we hear from real estate to small business to legal to housing or bankers, that you should use that expertise. Well, what I have is something that's oftentimes not included in the subset. While, yes, I'm a small business owner, I understand finance, I've been on a bank board. What's important to me is when we have inequalities, when we're talking about economic development and monetary growth, and we don't count ethnicity and race because it's a subset. And while I appreciate your comments on page 1 of your testimony, when you talk about the jobless rates have decreased, but because we know there's still so much disparity when we get to unemployment with people who look like me. So I have to be that voice for Black people and for minorities who get caught in the gap. So with that, I am very afraid because I know when we look at the economy and growth, if 22 million people are going to lose their health care, if we're going to cut programs where people then will have to or won't have the money to pay for them, I'm nervous. Now, with that said, I serve on the Financial and Economic Literacy Caucus. It is a Democrat and Republican, and as we're speaking now, I'm being appointed to the Congressional Black Caucus Economic Development and Wealth Creation Task Force as co-chair. You've stated that income equality is a long-term risk to our economy. We cannot talk about income equality without looking at the disparities and the discrepancies in household wealth among African Americans and minorities. So I would like to say that recessions like the one we just had, and there's a chart on the board that led, and I think it speaks for itself, that led to African Americans losing 52% of their wealth, while white households only lost about 16% of their wealth. I'm concerned that rising income equality will further exacerbate the problems for minorities with historically lower household wealth and higher unemployment. Can you explain to this committee why income inequality is a long-term threat to the United States economy, and who has the power to help us fix this?
Well, I am very concerned about inequality in income and wealth. I think Americans need to feel that the system, our system, economic system, is one where rewards come to those who work hard and play by the rules. And when some groups do disproportionately well and others seem to be lagging behind, as has been the case, there's a sense of it's being a very unfair system. Worse, to the extent that resources are important in assuring intergenerational mobility, that parents want to make sure that their children have access to the opportunities and ability to gain education.
Thank you. I'm going to interrupt you to yield my time back on opportunities. Thank you, because we introduced the Beatty Rule after the Rooney Rule, and now we have a black man for the first time, Chairman Bostic out of Atlanta, who is on the National Federal Reserve Board. Thank you, and I yield back.
Time of the gentlelady has expired. The chair now recognizes a gentleman from Indiana, Mr. Hollingsworth.
It's time to take a deep breath. You've reached the bottom of the rank on our side of the aisle, a mere private and a freshman. So I wanted to touch on something that my colleague, Ms. Tenney, had talked about in the Treasury report, and kind of better understand some of those recommendations that you might agree with and disagree with as well. I went through the report and kind of pulled out some of the ones that I think are most pertinent to your role in the Federal Reserve generally, either from a regulatory standpoint or with regard to monetary policy, and just thought I'd ask very specifically, kind of agree, disagree, and I know there may be some follow-up after that, but you'll have to remember I got probably a C- and probably deserved worse in economics, so mainly focus on the agree and disagree. Do you agree or disagree that there should be expanded treatment of certain qualifying instruments as HQLA, including high-grade municipal bonds as Level 2B liquid assets, and improvements to the degree of conservatism in cash flow assumptions incorporated into the LCR to more fully reflect banks' historical experience with calculation methodologies?
Well,
that's a long-winded one. They get
so
easy.
let me see. On the first part of it,
yes.
I think the Fed has gone further than the other regulators in including the more liquid municipal securities as Level 2B assets, and so we're supportive of that.
Marvelous. Second one, do you agree or disagree that U.S. rules implementing international standards should be revisited, including the GSIB risk-based surcharge, including the short-term wholesale funding component?
So we recently finalized that rule, and you know, I participated in that review, and I regard that as appropriate. I think the GSIB surcharges are at a level that I think is justifiable given the...
What about the mandatory minimum debt ratio, including the Fed's TLAC and minimum debt rule?
Well, I believe that's important as well, to ensure that that systemically important firms can be resolved.
Disagree with revisiting that. And the calibration of the ESLR for GSIBs?
Well, we discussed that earlier in connection with custody banks, and you know, it is something I think we should look at. It maybe having an unintended consequence.
So that we might agree with. Do you agree or disagree with the efforts to finalize remaining elements of the international reforms at the Basel Committee, including establishing a global risk-based capital floor to promote a more level playing field for U.S. firms competing internationally?
Well, I would like to see Basel III finalized. Our banking organizations are operating with very high capital standards.
Correct.
And this is mainly a matter of ensuring that other countries put into place appropriate capital regulation so that we have a level playing field. So yes, I'd like to see that happen.
Perfect. So agree with that. In the final implementation / finalization of the Basel III standards, would you exempt community banks from those? Would you exempt them from the risk-based capital regime that's promoted by Basel III?
Well, I'm supportive, of developing a simplified capital regime, but
for community banks specifically?
To the extent that community banks were affected by Basel III, I'm supportive of that.
Okay. Would you agree or disagree with raising the asset threshold of the Fed's small bank holding company and savings and loan holding company policy to $2 billion from the current $1 billion?
I think that's something we could look at.
Great. And then the last one of these that I had was, do you agree or disagree that the Fed should carefully consider the implications on U.S. credit intermediation and systemic risk from implementation in the United States of a revised standardized approach to credit risk under Basel III capital framework?
That was a mouthful.
Indeed.
Excuse me?
Indeed, yeah.
I need to get back to you on that.
Okay. Thank you so much. I really appreciate you taking some time and coming to see us again. I really enjoyed your first testimony and this one as well.
Thank you.
All right, with that, I yield back, Mr. Chairman.
Gentleman yields back. The chair now recognizes the gentleman from Washington, Mr. Heck.
Thank you, Mr. Chairman and Ranking Member Chair Yellen. A couple of years ago at the Humphrey Hawkins hearing, I asked you, when does America get a raise? I asserted America deserves a raise, fueled in part on my behalf because we'd been through 30 years of fairly stagnant wage growth with the exception of some warmth, as it were, in the late 90s. I respect you because of your prowess as an economist. I admire you because of what I perceive to be your commitment to some values, including a concern for how the Fed's policies actually impact Americans, and that includes in this area of wage growth. I believed it 2 years ago. I believe it now. 2.5% nominal growth, while better than a few years ago, does not render Americans feeling as though they're getting ahead, let alone staying even. So, given your commitment, or my perception of your commitment to the average American, if such a thing exists, I read with great interest in the Monetary Policy Report, the table on page 42, which essentially indicates that you project a definition of full employment over the long term of between 4.5 and 4.8% if you get monetary policy right, 4.5 to 4.8%, and yet an indication that 2 years hence the unemployment rate will be 3.8 to 4.5%. Little hard for me to read that as other than you're trying to or willing to let the economy run a little warm, presumably because maybe we can get wage growth above 2.5% and maybe closer to historic recovery rates of 4.0%.
Well, inflation is running over the last 12 months at 1.4%, below our 2% objective, and we've had 5 years or more of inflation running under our 2% objective. That's a commitment that we have, and it's a symmetric objective. And I think allowing the labor market, allowing unemployment to decline to the kinds of levels that you cited looks to be consistent with achieving our inflation objective.
And would yield higher wage growth than 2.5% you would expect?
Well, I think wage growth seems somewhat low given our 2% objective, but it is very important to remember that one of the things that's holding down wage growth in real terms is very low productivity growth. over the
I don't
last...
want to go down that rabbit hole. We did that last time.
I mean, that, you know, without that changing, that really limits the long-run prospects for workers.
I get that, and I get the controversy surrounding our measure of productivity of late. The fact remains, America needs a pay raise. I take a fairly straightforward view of this. It seems to me that the economy, if we fall into a recession, the Fed cuts interest rates, and that increases availability and demand for loans, for the purchase of homes, for the purchase of automobiles, which has a stimulative effect on the economy. It didn't happen this time with respect to housing necessarily. It didn't respond. It did in autos, in fact, fairly robustly, until recently. And now auto sales are going down. There are layoffs literally in the industry. You have described the monetary policy approach you're taking as still accommodative or stimulative, but that's not occurring in autos, especially given what I said earlier about I genuinely believe you care about how average Americans are impacted. Homes and autos are the two biggest purchases that most Americans ever make. It didn't work at all through the recession in homes. We're stuck back at 1994 construction levels, and it's now not working on autos. Are you concerned?
So mortgage rates are a little bit off their lows, although they're down from last year. Look, I think you have to look at the bottom line, which is this year we've had 180,000 jobs created a month, only slightly lower than last year, 190,000 or so. The unemployment rate continues to decline. The labor market continues to strengthen. And that means that even if auto sales are off their highs, that we have strong enough demand through consumer spending, a recovering global economy, a pickup in spending on plant and equipment, that it is supporting continued job creation at rates greater than the labor force growth.
Time of the gentleman has expired. The chair now recognizes the gentleman from Oklahoma, Mr. Lucas.
Thank you, Mr. Chairman. Chair Yellen, before asking you anything, I'd like to express concerns about the treatment of centrally cleared customer margin under the supplemental leverage ratio. I'm concerned, as others are, that including this margin in the denominator of the ratio is artificially reducing the number of clearing options available to customers. As you may be aware, lots of end users in my district use clearinghouses to hedge against risk in both ag and the energy markets. But I'm encouraged by the recent Treasury report on reg reform suggesting that this margin is no longer should be a part of the ratio calculation. In addition, your colleague, Governor Powell, told the Senate recently that the Fed is reviewing the leverage ratio, and I would agree with him that fixing this is critical for the health of the markets, and I look forward to the outcome of this review. Madam Chairman, I would like to discuss the 2013 leveraged lending guidance. In my district, the energy sector is one of the largest employers. As you and everyone else is aware, the energy industry is going through a bit of a tough time these days. And now, for the purposes of leveraged lending guidance, the recent energy downturn means many, if not most, energy companies are qualify as distressed industries, meaning the guidance limits the ability of those companies to get credit and the loans they need to stay in operation and to employ my constituents. The guidance also concerns me a bit because of the manner in which it was rolled out. The guidance in 2013 and then a series of FAQs in 2014, and that's not exactly the most clear process, has forced institutions to review every loan they made to ensure compliance. The administration also appears to share my concerns, recommending in their recent Treasury report that the guidance be revisited. Chair, have you considered retracting the guidance? And along with that thought, also, have you met with any industries that are considered distressed to hear about their difficulties in obtaining credit?
Well, we put in place the leverage lending guidance, I think, for a very good reason, which is we were concerned about underwriting practices for those kinds of loans and want to make sure that lending is safe and sound. We had shared national credit exams that resulted in disturbing findings about the quality of underwriting of those loans, and I think it was appropriate to put such guidance in place. If they're having unintended consequences, I will discuss with my colleagues, looking at that, but believe it was important to have put that in place.
Well, I'd very much appreciate that, because the energy sector is not just important to the 3rd District of Oklahoma, but it's important to the entire national economy. And with the technological advances they've adopted, where we've now gone from, in many regions of the country, no longer being importers of, for instance, crude oil and natural gas, but exporters, the effect that they are having on our overall balance of payments, the potential opportunities there are just incredible. And these guidances from 2013 and the FAQs from 2014 seem to be causing some real stress out there as they're being interpreted. And your commitment to look at those, to try and make sure we don't create unintended consequences, because the number of barrels of oil are still in the ground in those proven reserves. The number of BCF of natural gas is still there. The technologies that have enhanced and reduced the cost of our production are still in place. It's just we have to work our way through a tough time, and bearing that in mind by the Fed and yourself, I'd very much appreciate that, Chair. And with that, Mr. Chairman, I'd yield back.
Gentleman yields back. The chair now recognizes the gentleman from Maryland, Mr. Delaney.
Thank you, Mr. Chairman. And thank you, Chair Yellen, for your incomparable leadership at the Federal Reserve. It's always nice to have you here. And we're getting towards the end, so I thought I would ask a question and kind of tap into your knowledge as a macroeconomist and think about some of the long-term trends of employment. There's been a lot of talk recently about what will happen to the future of work and jobs based on technological innovation, automation, machine learning, artificial intelligence, whatever the category may be. And while historically innovation has created more jobs than it's displaced, it generally does come with a lot of fear as to what will happen to the labor market. And maybe that's because we can see the jobs that will be displaced, but we don't really have a good ability to really imagine the jobs that will be created by this innovation. And this has caused many people to start talking about things like universal basic income, where they're kind of talking about how there'll be no jobs in the future, and robots and machine learning will displace all the jobs, and we're going to have to figure out ways of supporting people. To me, that's premature for obvious reasons. Unemployment's very low. There's a lot of jobs in society that are being done that no one gets paid for, and we should certainly try to figure out how to pay those people for what they're doing before we start paying people to do nothing. And again, historically, more jobs have been created. But what is your thoughts on this topic as someone who spends a lot of time not only thinking about the macro, but obviously someone who cares deeply about employment and its importance to people's dignity and ability to raise their family and earn a living? So well, how is this going to play out in your opinion?
So I don't have a crystal ball, and these are very difficult
But you're
issues.
very smart, and you look at a lot of data, so.
Well, I mean, I know technological change has been a tremendously important source of growth and improvement in living standards in the United States and around the world. And so it's something that we should want to see and foster. But it is disruptive, and it can cause considerable harm to groups whose livelihood is disrupted by technological change that renders their skills less valuable or not at all valuable in the market. And I would expect that the kinds of technological changes that you describe will continue to change the nature of work, the kinds of jobs that will be available, and the skills that will be needed to fill those jobs. And to my mind, a very important focus for all of us should be.
So what should be the 3 things we should do to prepare? Because I agree with you, it's going to change the nature of work, it'll create jobs, it'll displace jobs, and people need different skills. What would the 2 or 3 things you would do to best prepare the future to be able to succeed now?
So to my mind, education and training are absolutely central to the ability of workers to fill the new kinds of jobs that will be available and have the skills. When I talk to businesses that are adopting new technologies, they tell me it's also creating new kinds of jobs, that they find that younger workers, even those with less education, have nevertheless been exposed to the kind of training that will enable them to fill the kinds of technical jobs that have been created with appropriate training. But it's a tremendous challenge for older workers who don't have that kind of training to make adjustments. I would look, both to ensure that we have appropriate training, education, apprenticeship programs, and other things for younger people, and also to see what we can do to relieve the burdens on older workers who are displaced.
So if I could kind of summarize what I think I just heard you say, you're not necessarily bearish on the future of jobs and work.
Correct.
You agree that new jobs will get created, offset displaced.
I believe so. I think that's...
But you are worried that we're not doing enough, or you think we should do more in reforming education, training, apprenticeship programs, et cetera,
well, that is
because the challenges are going to be very significant.
That is certainly a key focus for me.
Thank you again, Chair Yellen.
Thank you.
Gentleman yields back. The chair now recognizes the gentleman from Illinois, Mr. Holmgren.
Thank you, Chair. Thank you, Chairman, and thank you, Chair Yellen, for being here. Chair Yellen, the financial sector's commitment to cybersecurity is perhaps better than any other. Unfortunately, many have recently raised concerns that while well-intentioned, many regulators are starting to require duplicative, conflicting, and improperly calibrated requirements. We want to keep everyone, regulators and industry, moving in the same direction, and that is to achieve stronger cybersecurity. Do you believe the efforts by the Treasury Department to coordinate regulatory harmonization of rules and requirements with respect to cybersecurity, do you support those efforts?
I am supportive of those efforts, and we have certainly heard in our own outreach on cybersecurity the importance of having uniform standards so that firms are not facing different regulatory demands that may be technologically conflicting, and I think that is an important goal.
You maybe have answered this enough, but just to dig in a little bit more specifically, in its recently released report in response to the President's executive order on financial regulation, Treasury Department called for federal banking regulators to harmonize cybersecurity regulations using a common lexicon. Wondered if the Federal Reserve is committed to achieving this goal.
Yes.
Great. During the last appearance that you had before this committee, I expressed my concern about the treatment of centrally cleared customer margin under the supplemental leverage ratio. The regulatory treatment of customer margin diminishes clearing options for customers while forcing them to pay more for these services. I applaud the Treasury Department's recommendation in its core principles report to grant an offset for centrally cleared customer margin under the leveraged ratio. An offset would have a relatively insignificant impact on bank capital while driving down costs for clearing services. I understand British regulators have already granted an offset for client margins in the UK, and the EU is expected to offer European banks an offset as well. For the sake of clearing customers in the United States, I hope the Federal Reserve will follow suit and work with its fellow regulators to adopt an offset for U.S. firms.
Well, I think the supplementary leverage ratio may be having unintended consequences, and it is something that we should look at very carefully. I'm committed to doing that.
Thank you. Chair Yellen, on a similar note, on June 22nd, Federal Reserve Governor Powell testified before the Senate Banking Committee that, and I quote, "We believe that the leverage ratio is an important backstop to the risk-based capital framework, but that it's important to get the relative calibration of the leverage ratio and the risk-based capital requirements right. Doing so is critical to mitigating any perverse incentives and preventing distortions in money markets and other safe asset markets. Changes along these lines could also address concerns of custody banks that their business model is disproportionately affected by the leverage ratio," end quote. And on April 4th, former Governor Tarullo gave a speech where he stated, and I quote, "As to the impact of the 2% enhanced supplementary leveraged ratio, our experience leads me to believe that it may be worth changing to account for the quite different business operations of the GSIBs, particularly those in custody business," end quote. He further stated, and I quote, "In practical terms, the asymmetry is most significant for the two banks that are dominantly custodial and transactional in nature, rather than lending and trading firms. These banks have had the lowest risk-based surcharges of the 8 GSIBs, currently 1.5%, but their leverage surcharge is 2%. This is especially problematic for their operations since they prudently reinvest customer deposits into safe and liquid assets," end quote. Furthermore, the Treasury Department's June 2017 report states, and I quote, "Exceptions from the denominator of total exposure should include cash on deposit with central banks," end quote. I wonder, do you agree with this assessment, and when we could expect the Fed to take action to address these concerns?
So I agree with the comments of my colleagues that the supplementary leverage ratio may be creating the set of problems that you addressed. You discussed there are different ways of dealing with it, committed to looking at it and trying to recalibrate it so that it avoids these adverse consequences.
I know it's maybe difficult to say, but do you expect that the Fed will take action before January 2018 when the new enhanced supplementary leverage ratio goes into effect?
Let me get back to you on a timetable.
Thanks again, Chair Yellen. Appreciate your work and appreciate you being here today. I yield back.
Gentleman yields back. The chair wishes to advise all members that the chair intends to release the witness at 10 after 1 and anticipates clearing 4 more members from the queue. The chair now recognizes the gentleman from Texas, Mr. Green.
Thank you, Mr. Chairman. I thank the ranking member as well. And Ms. Yellen, I thank you for appearing today. I'm looking at currently an article from the Washington Post dated May 17th, 2017. It's styled, "The nation's biggest banks have a common gripe. They have too much money." I'd just like to read some of the relevant portions. Banks are sitting on a $131 billion in excess capital, according to March research report by Goldman Sachs. If capital requirements are lowered, banks can return the money to shareholders in the form of dividends, boosting the payouts perhaps by 45% in 2018. This is according to the Goldman Sachs report. Hampering the industry's arguments has been record profits. Despite higher capital requirements, the country's banking industry reported more than $171 billion in profit last year, and the volume of bank loans has increased significantly since the financial crisis. So the question I have, Madam Chair, is this. Should we change the capital requirements simply because we can have the opportunity to return more dividends, boost more payouts? Is that a good reason to change capital requirements?
I strongly believe that we should have strong capital requirements for the safety and soundness of the banking system, the financial sector more broadly. I'm comfortable with the level of risk-based capital requirements that are in place at this point, and especially the most systemic firms should have the largest capital buffers. So once those capital buffers are in place, the Federal Reserve has no objection to firms distributing profits as dividends to shareholders or in the form of share repurchases. This year in our stress tests, we approved the plans of almost all of the firms involved to return capital to their shareholders, but that's because we're comfortable that they've built the capital buffers that are necessary for a safe and sound banking system, and comfortable that they can go on even under severe stress, meeting the credit needs of the U.S. economy.
Thank you. Let me move to another topic because this is quite important and I don't want to neglect it. Thank you for your response to the letter that I and some 36 colleagues sent you concerning the African Americans, Latinos, and the fact that the unemployment rate for African Americans and Latinos always seems to lag behind Anglos. I'm mentioning this to you now because in your letter you do cite some things that may be beneficial in terms of some studies that will take place. But I do want to call one thing to your attention, and it has to do with something that these studies probably won't address. And it's just the issue of race itself, just race itself. Plain old invidious discrimination. We have a difficult time legitimizing invidious discrimination as a cause for unemployment being higher among certain groups. We know that it exists, but we can't get the actual empirical evidence to legitimize the existence. Can the Fed, aside from these additional things that you'll be doing, and I salute you and applaud you for doing them, but can the Fed endeavor to engage in some sort of process that will allow us to acquire this empirical evidence? Because until we can present that, we still have persons who are in denial. Your response, please.
So it is certainly something that we can try to get at, although perhaps not definitively in studies that we do. There are studies that I'm aware of, experimental type studies that do pretty clearly document what you're talking about, that economists have produced.
One quick, if I may just ask this, could we explore the possibility of allowing testing to take place within banks? That's something that we have difficulty acquiring, the testing empirical evidence.
I need to look into that. I'm not.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman. Afternoon, Chair Yellen. Chair Yellen, do you subscribe to the theory that monetary policy can work better if it's independent of politics?
Yes, I do.
Well, in that light, does your opinion about monetary policy independence also extend to independence from distributional politics?
Distributional politics. I think the Fed should be non-political.
Yes, ma'am. Well, I've reviewed some of your speeches since last March. I didn't see a lot relative to monetary policy. I did see one speech where you appeared before a community development research conference, and it was a conference on creating, quote, a just economy, and a conference that you also spoke at on women at the Brown University. The monetary policy was mentioned only one time in that speech, and that reference was in context of explaining why monetary policy is poorly equipped to address, quote, pockets of persistently high unemployment. It just appears that these speeches represent efforts to address social issues in a way that establishes the limits of sound monetary policy. Do you also worry that these, in the same way, it exposes monetary policy to increased risk from distributional politics?
Well, let me say that it's my core responsibility to speak to the American people in a wide range of forums about the conduct of monetary policy in the economy, and I would disagree with your characterization of my presentations. In March, I gave an important speech in Chicago on monetary policy. I've had two press conferences after the March and June meetings. I recently gave remarks in London bearing on the U.S. economy and monetary policy. And if you go back a little longer to January, you'll see many speeches to many different audiences at many levels, as well as testimony.
Yes, ma'am. I was just looking at the topics relative to the two speeches at Brown University and at this.
So let me just say that the Federal Reserve has other responsibilities, and in particular, we have extensive programs in community development that are related to our CRA. I spoke at a conference relating to community development that was run by the Board of Governors.
Reclaiming my
seems
time,
entirely
if you don't mind.
Appropriate.
I think I made my point that those particular ones were political. Paul Kupiec, a resident scholar at the American Enterprise Institute, has stated that, quote, supervision and regulation are now so intrusive that it is not a stretch to say that the largest financial institutions are being run by the Fed. Do you agree with that assessment?
No, I don't.
Well, do you believe it's appropriate for the Federal Reserve to engage in specific firm risk management by influencing corporate governance structures across any industry?
I do believe it's appropriate for the Fed to ensure that there's sound corporate governance in major financial institutions. And we saw what happens when that's not the case. That was part of how we ended up with the financial crisis.
So you believe that we needed more government intrusion and more government management than that would have salvaged the problem?
I believe that we should ensure that
you don't believe that the government itself played a direct role in the financial collapse that we had in terms of forcing financial institutions to make loans to people who weren't even credit worthy?
I don't believe that was the main cause of the financial crisis.
Well, many of us disagree with that. Chair Yellen, do you believe that the Federal Reserve has the ability and the authority to usurp or preempt state corporate law?
So I'm not sure what you have in mind there, and I'm not going to give a simple yes or no.
Well, are you aware that companies that are incorporated in each state are subject to that state's corporate law requirements, including the fiduciary duties and obligations imposed upon the directors of a company's board?
Okay.
Well, do you believe that you have the ability then to usurp the laws?
We're not usurping the laws. We're making sure that companies operate in a safe and sound fashion and that their boards of directors
If the state has
responsibilities.
laws relative to those corporate boards, do you believe that you have the authority to usurp those laws?
Well, Congress has passed laws that place obligations on us to supervise these financial institutions.
My time has run out. Thank you.
Time of the gentleman has expired. The chair now yields to the gentleman recognized, the gentleman from Arkansas, Mr. Hill.
Thank the chairman and Chair Yellen. It's nice to see you here and looking fit and rested from all your travels. Thanks for your perseverance in front of us. We've talked before about monetary policy, and I haven't been a fan as a banker before I was in Congress of going beyond the Fed's initial interest rate policies. I felt like QE 1, 2, and 3 didn't produce the GDP effects or the job increases that perhaps Fed policymakers at the time thought. And I've also been concerned that as we go back and look backwards now since 2008, that Fed officials really have always been a little reluctant to talk about some of the unintended consequences of that, such as distorting the price mechanism in our economy, depressing cap rates for commercial real estate, or running up equity prices, which I think are a result when you have that we've flooded from QE2 into our economy, affecting price earnings multiples, et cetera. But today I haven't heard any discussion about we've talked about the balance sheet, we've talked about setting interest rates, but I want to talk a little bit about the money multiplier aspect in your toolbox. You know, we've flooded the system with reserves, but we have a money multiplier that's down at Eccles rates, 1930s type rates. And I guess my view is, shouldn't you lower the rate of interest paid on banks on excess reserves as you're raising rates and planning this very thoughtful, careful shrinkage of the Fed's balance sheet?
Well, the interest rate we pay on excess reserves is our key tool to adjust the general level of short-term interest rates in the economy. And the committees deemed it appropriate to gradually raise the level of short-term rates as the labor market has strengthened and we've come closer to achieving our objectives. So no, I wouldn't agree that we shouldn't be using that tool to normalize the general level of short rates in the economy.
The rates on excess reserves.
That is our key tool that we use to adjust
how do we get the money?
How
do we get the money multiplier to increase then?
Well, I guess I don't look at the impact of monetary policy on the economy through the money multiplier. I think
what do you think accounts for it being at 1930s levels when we've advanced reserves into the system as mightily as we have over the last 8 years?
Well, we had a highly depressed economy where interest rates fell close to zero, and banks were willing to hold on to excess reserves given.
But my colleagues on the other side say that the lending business is booming and the economy is growing successfully. So why is the multiplier not changed? Why is the velocity still low like that?
So,
in your view, that's something we measure. That's how we measure successful Fed policy, by looking at that. So I'm just
I mean, I wouldn't agree at all that we measure the success of Fed policy by looking at the money multiplier. I think the quantity of money and its relationship to GDP has been extremely unstable and not a good way of running monetary policy. I'm not aware of any central bank that would any longer approach it that way.
And why is that? Why is it, though, that it was between World War II and 2008 something that people looked at and it was talked about as a way that shows that we have a healthy investment and lending market and growing economy, but in the 1930s and since 2008, we're just satisfied with it, that it's low, and we don't say it's important anymore. Can you put some perspective on that?
Well, both in the Great Depression and in our more recent Great Recession, we've had a situation where short-term rates fell essentially to 0%, and pushing out additional reserves was essentially what they said during the Depression was like pushing on a string, and we encountered, or a so-called liquidity trap, and the relationship then between the quantity of reserves and nominal income begins to break down in those situations. And we faced a similar situation that is to what we had during the Great Depression.
My time's expired, Mr. Chairman.
Time of the gentleman has expired. The next member will be the last member we call upon. I now recognize the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you, Mr. Chairman. Chair Yellen, thank you for being here today. I really appreciate your testimony, and thanks for the work you and the team at the Federal Reserve do to get our monetary policy right.
Thank you.
I want to understand that a little bit. You've talked about your policy as neutral to accommodative, but what you've started to do is at least talk about applying the brakes. You've raised rates. You're talking about how to, frankly, you talked just briefly about the supply of money being a little unstable. Well, $4 trillion of it, we know where it went, but it did create some velocity in the money supply that's non-typical. So is what you're doing now essentially gently applying the brakes if you felt like the economy is doing it?
Yes, I think that's a fair characterization. We've had our foot on the gas. We've been in an accommodative stance, and as we've come closer to achieving our objectives, we've taken our foot off the gas to some extent so that we can sustain a strong recovery. But we're moving towards something closer to, let's call it a neutral stance that keeps the economy operating on an even keel.
Historically, applying the brakes gently or at the right time has been a challenge, just
Correct.
like it's been a challenge to hit the gas. I guess everyone always feels optimistic about their course of action at the time. Generally, people say bubbles have been one of the things that have caused this miscalculation. What bubbles do you see out there in the macroeconomy right now?
So I try not to opine on the level of asset prices, although our report notes that valuations generally are toward the top of their historical ranges. What I try to think about is if there are adjustments in asset prices, what consequences would they have on our financial system and our economy? And in that context, look for evidence that surging asset prices might be leading to imprudent borrowing, a buildup in leverage in the economy that would be dangerous if the prices were to unwind. And we're not seeing that. So we sort of judge financial stability risks at this point as moderate.
So as you've laid out a good plan, and I don't really want to go over the whole thing. You've talked a lot about it, but I am particularly concerned about the role that you kind of allude to here. As we start to see instability, you kind of shift hats from monetary policy to regulator. And in the regulation, you talked about, really a pretty heavy hand in the sense of steering companies on policies. The Financial Times has highlighted cases where you've even, as regulator, addressed HR practices up to the point of advising, terminating, or replacing certain employees in companies. And at that point, I guess, how critical is it that our agent of monetary policy also serve as a regulator? I'm not saying that regulation doesn't need to be done. How important is it that our central banker does that?
So I would say, especially in the aftermath of the financial crisis, we've found that our understanding of the economy, of the financial system, and of appropriate monetary policy has been greatly informed by the role we play in supervision. It's helped us understand risks to financial stability, pressures in particular portions of credit markets, and there's been a close integration between what we learn in bank supervision, financial stability, and monetary policy.
Right, well, and most closely on the mortgage-backed securities markets, where you guys developed a strong affinity for them and accumulated quite a lot of them. Which gets to the monetary supply. So at this point, you're looking at some of the asset purchases that you've made, really directly interacting with a key part of the market, putting those on your balance sheet, unwinding them. You've talked about a plan to do it. You've talked about a change of plan to do it. What do you see as the risk to the monetary supply? And you talk about, not to say it's a bubble, but clearly there's going to be an effect on asset prices as you try to get that right.
So we do believe that our asset purchase programs were effective in pushing down longer-term rates and the so-called term premium embodied in longer-term rates. And very gradually over time, as we shrink our balance sheet, I would expect some modest, but over a number of years, upward pressure on longer-term rates. It's not something very substantial, but it is something that we've taken into account in deciding on what is the appropriate path for the federal funds rate.
Thank you, Chair Yellen. Thank you, Mr. Chairman. I yield back.
Time of the gentleman has expired. I want to thank our witness, Chair Yellen, for her testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions to the witness to the chair, which will be forwarded to the witness for her response. I would ask our witness to please respond as promptly as you are able. This hearing stands adjourned.
quantitative easing.
Janet Yellen returns to Capitol Hill tomorrow for a hearing of the Senate Banking Committee. We'll have live coverage at 9:30 Eastern Time on C-SPAN 3, cspan.org, and the C-SPAN radio app.